is kind of a murky data picture.
We need to be careful of some of these cracks in inflation data.
There are certainly signs that the labor market is more fragile than it looks.
What we're really waiting for is this pass-through of inflationary impact.
I really don't know that we're at the cusp of something dramatic happening to this economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, just short of all-time highs. Investors looking ahead to Q2 earnings from the Mag 7's Tesla and Alphabet. Fed officials enter the blackout period, leaving the president waiting for rate cuts as the European Union is facing down a trade deadline, hoping for the best and preparing for the worst.
It sets up a real question of how do different regions respond to hardening rhetoric coming out of the Trump administration as we get closer to the latest deadline of August 1st, especially given the fact that there are political considerations at home. And we'll talk about that with Japan in particular. But with the European Union, a big question here, do they go nuclear and really go to the option of retaliation with measures such as taxing tech giants from the United States in response to levels that are not plausible for them, like 15 to 20% tariffs?
Or will this White House just take the win? Take the win. The EU, based on our reporting, is prepared to accept an unbalanced trade agreement here, accept that 10% tariff and walk away. But it seems like, based on what we're hearing over in Europe, that the Americans are pushing for more and pushing for more.
And what you have right now is actually no movement, a ton of activity. Once again, you're going to have negotiators likely in Washington, D.C. Yesterday, Commerce Secretary Howard Lutnick was on Face the Nation and said, I just got off the phone with them. And when he was asked about, what if they go after Boeing? What if they go after Kentucky bourbon? What if they go after soybeans in Louisiana, the home state of Speaker Mike Johnson? He says they're not going to do it. They're not going to do it. It is this moment that the U.S. is trying to extract whatever they can with 11 days to go.
You say no movement in trade talks, no movement in this market, very close to all-time highs. Deutsche Bank this morning, we expect another leg up in equities. This came from Mike Wilson of Morgan Stanley. What did he say? We think dips are meant to be bought. You're seeing that on repeat across Wall Street.
Which has led to this FOMO type of environment, a fear of missing out, which has legs of its own when you start having people pile in just because they're worried about not getting the sort of gains that you potentially could get. I just wonder if people are getting a little bit too excited about looking past the noise that we have seen throughout the year in terms of policy shifting under the hood and just looking to this industrial revolution tied to investing in new tech. And that, I think, is one of the things that's really driving a lot of optimism about CapEx, et cetera, even amid all of the headlines that we talk about every day that exhaust us.
The data has been okay.
Yes.
Headline data, CPI, PPI has been okay. We can talk about the details through the program. Retail sales and jobless claims last week have been okay. Corporate America continues to say all the right things. And there's still a strong bias of this Federal Reserve to cut interest rates. Even with that strong bias to cut interest rates, the tension continues to build between Chairman Powell and the President of the United States. And over the weekend, throw in the Treasury Secretary, Scott Bessent.
President over the weekend came out with a Truth Social post following this Wall Street Journal article that said Treasury Secretary Scott Bessent laid out his argument on why the president should not even consider firing Fed Chair Jay Powell. And this is what Trump has to say, quote, nobody had to explain that to me. I know better than anyone what's good for the market. So basically, it's almost an acknowledgement from this president that he knows the negative impact on the market and the economy if he was to fire Jay Powell. So then the question is, why does he continue to bring it up every single day?
Is Bessent out of the race now, based on those comments?
Bessent's out of the race just simply because there's no one who can replace Scott Bessent, who's currently in Japan trying to smooth over whatever kind of mess is going to come from that election. And meanwhile, you have a situation where ultimately he is the only adult in the room. A lot of people think. I don't want to get there, but I just went there. I mean, there's a real question here about whether there will be credibility for the next appointee to be the chair of the Federal Reserve, given all of the rhetoric and given all of the political speculation, regardless who it is.
Live from New York, welcome to the program. Looking ahead to a quiet week, we hope. At least the schedule's light. Equity futures on the S&P 500 positive by about 0.25%. Coming up this hour, we'll catch up with Lori Calvasina of RBC, with stocks trading very close to all-time highs. Patrick McHenry, as the US trade team hardens its stance, and Angelo Zino looking ahead to big tech earnings. We begin this hour with stocks trading near record highs ahead of a big week for tech earnings. Lori Calvasina of RBC writing, we're lifting our year-end price target to 62.50. We reviewed what we've learned from early reporters, which makes us think it's too early to start worrying about tariff impacts. Lori joins us now for more. Lori, good morning.
Good morning.
I was going to characterise this as a reluctant raise from you and the team. How would you describe things?
Look, I just think at a certain point you realize investors are thinking a little bit differently than you are, and you adjust and move on. And that's what we did with our target raise last week. I was basically living on the road in June talking to investors all over the country, and I heard time and time again people felt like they paid the price for whatever economic wobbles we were going to have, whatever inflation, kind of challenges we were going to have back in April, and it was time to move on to 2026. And I'll tell you, the first few times I heard that, my jaw dropped. But as you start hearing it from more and more people, of different backgrounds, you realize you've got to bake that into your thinking. And so that's essentially what we did. And one of the things we did was we removed sort of our policy assumption. We had been telling people, we had been baking in sort of a business-friendly backdrop at the beginning of the year. We weren't baking in sort of 2018 type scenarios, to our more recent ones. We didn't feel like that was appropriate anymore. So we took that out, and we put in a test that evaluated how stocks perform ahead of the economic environment people think we're going to get next year. And the result of the math is that it pushed the numbers up. It's
a big question, I think, for all of us around the table. How do you price in 26 without resolving policy issues in 25?
Well, that's a great question, and I really pushed hard on that. And, I do think there is an issue. If you go back to April 8th, and we saw that growth scare low, that 18.9%, that was baking in some pretty onerous stuff at that moment in time. What we've heard from corporate America since then, I would say, is not off to the races by any stretch of the imagination, the same way the stock market, has been kind of off to the races. But I do think corporates are doing their best to manage through this issue. We need a lot more detail from them, especially on inventories going forward. But at this point, if I think back really to the first trade war back in 2018, companies have been tested time and time again, and they're taking a lot of pride in their ability to manage through. And so we have continued to hear that from corporate America. Now, I'll warn you, John, it's not all easy. I think this is going to be somewhat messy in this reporting season because not everyone is going to have that ability to execute. And some of the early reporters did not, and they got punished for it in terms of their stock prices. But I do think generally, if you're kind of zooming out, the S&P companies are really trying to manage through this best they can.
You say you removed your attempt to quantify what policy can mean for the market. So what are you left with when you look at Washington? Do you just think it's so uncertain that you could absolutely ignore it? What's the risk in that?
Well, look, I think, before we sort of had the typical kind of business-friendly environment, we had something more onerous before. The answer is something in between, and I'm not quite sure what number you put on that in between. But I do think, that there are different, what's the right word, crosswinds. Right, you've got some tailwinds, you've got some headwinds, and as investors, we're going to be battling that out any given day in the stock price. But we do know that investors are trying to take this long-term issue. And I'll tell you, Annmarie, the other thing that sort of cemented this in my head, and I think I was talking with someone on Bloomberg, it may have been all of you around this time, but looking at the Middle East situation, I didn't think that was going to necessarily tank the market, but I thought that we might have at least gotten a 5% drawdown. And what I really heard from investors, on some calls we did, was really a desire to look longer term on that issue as well.
When it comes to how Trump right now views the market, over the weekend, he was talking about no one needs to explain anything to him, especially when it comes to the firing of Jay Powell. He went on to say, if it weren't for me, the market wouldn't be at record highs right now. Well, if it weren't for him, would the markets actually be higher? Because the market is still, at least some investors, likely pricing in the question of an independent Fed, what is going on with tariffs. The only real certainty is the one big beautiful bill and deregulation.
Right. And I think deregulation is something, if we just kind of take each of those individually, I think deregulation is obviously a positive for financials. Our analysts have also pegged it as a positive for energy, though there also are some offsetting issues with the lower oil price, which has been a goal of this administration as well. And so, that impacts profitability. It makes it somewhat complicated. But generally what I've told people is I have a hard time knowing how to model deregulation in terms of what dollar value that's worth to earnings. It feels like a tailwind, but a bit of a vague one to me. The one big beautiful bill, if we think about that, and Lisa, your comments on CapEx earlier, I don't know that people are necessarily, in my conversations at least, I think the AI bullishness is there. I don't think that has changed, or if you were a skeptic, that hasn't changed either. But I'm hearing a lot about bonus depreciation and how that might spur plain old-fashioned CapEx. I'm watching out for that. I've gotten mixed feedback on that from my analysts, so I think we keep an eye on that as well. If you think, though, Annmarie, and I think this is sort of one great lens to look at this through, if you look at consensus GDP forecasts, and that's a big driver of revenue on earnings, we're stuck in the 1% range, whether you're looking at RBC views or consensus views. Back at the beginning of the year, that was at 2%. So that's just not back to where it was. And inflation numbers are generally up as well, which weighs on your multiples. So I do think that we have endured some pressures here. And frankly, I got some questions even before this target raise. Why aren't you just going back to your 6,600 back back in January. And I've been very adamant with people, this is not the same world that we were in back in January.
I'm so glad you could make it in, because I know that around this time you typically have your head buried in all the earnings calls and just parsing through all of the transcripts. And what we're hearing from companies doesn't match what we're feeling in markets, something you pointed out.
Yeah.
Does that matter, or is that just a whole bunch of corporate executives sandbagging us until next quarter?
So I think it matters in the sense that if I look at the soft data, and we always like the Duke CFO survey because it comes out right before earnings and it kind of gives us a good sense of the tone ahead of things. When we look at that, when we look at a couple of these other C-suite surveys that have come out recently, they haven't seen the same inflection that we saw in things like NFIB or the Conference Board Consumer Survey or the University of Michigan survey. So the stock market's been queuing off those kind of consumer small business sentiment inflections. But I think it's important to note that even in the data, if you're not just taking my word for it, right, in terms of reading all these things, even in those soft data prints, we haven't seen that same inflection. And I don't think investors realize that.
Do you feel like we're all just exhausted about being bearish and being wrong, and so you're hesitant to really have anything that's below where we're currently at?
I think that you have to listen to the market, and you have to listen to kind of what people are telling you they're doing in terms of making decisions. And it was funny, I was doing a dinner with Elsa Linos, our FX strategist. I forget exactly what point this was. I think it was late June. And she sort of made the comment about, what can you forecast with any reasonable degree of confidence? And it seems like there's sort of, at the time, this dinner we were talking at, kind of general uncertainty. Can we forecast the next 3 months? That didn't seem to be like a high confidence level. But longer term, people tended to have more conviction on. So if you get these wobbles in the market and you have a stronger longer term view than shorter term view, why not go ahead and trade on that? That actually makes sense to me.
We was an interesting word then. We all getting exhausted of being too bearish.
We are tired from this debate at home every night. Yes, exactly. I think, look, there is a feeling that if you start worrying about certain things over and over again and people just start slamming you for it and you're wrong, you start to wonder, should I worry about anything?
That's the drawing, the sucking in sound, right?
That's the
that's
FOMO.
it.
That's where we're at right now.
Laurie, it's good to see you.
Good to see you too.
Thanks for being here. Laurie Calvasina of RBC. Looking ahead to lots of earnings over the next week. It starts on Wednesday with Tesla and Alphabet. The following Wednesday, we'll hear from Microsoft and Meta. Then next Thursday, you'll hear from Amazon and Apple. Then, as Lisa said just last week, in 10 years' time, on August 27th, you'll hear from NVIDIA. They've got to fix that, haven't they?
I mean, come on. They're like the key player here to give us a sense of AI investment. And they don't come until we basically started in Q3 earnings season. So at a certain point, you have to wonder, okay, are they really just trying to be different? Do they need to? Jensen Huang, come on, be the rock star, put on your yellow leather jacket and come out just a couple weeks
By
earlier.
August 27th, we'll be pricing in 2028, won't we, in equity markets? Equity futures on the S&P, positive here by a third of 1%. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Good morning, John. President Trump and Xi Jinping are reportedly expected to meet at or before the APEC summit in October. The South China Morning Post cites sources saying Trump could make a stop in China on his way to the summit in South Korea, or they can meet on the sidelines. Sources telling us here at Bloomberg that Trump has been dialing down his aggressive tone with China in hopes of securing a meeting and a trade deal. Meanwhile, Stellantis shares are falling in European trading nearly 1.7%. The automaker reported a $2.7 billion net loss in the first half due to restructuring expenses, weak sales, and the impact of U.S. tariffs. Analysts had expected a small profit. And because of the trade uncertainty, the company has not yet issued financial guidance for this year. And Microsoft server software was exploited by unidentified hackers. The U.S. Cybersecurity and Infrastructure Security Agency said hackers accessed file systems and internal configurations. In response, Microsoft said it released a new security patch to mitigate active attacks. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes from now. Up next on the programme, pushing for a deal.
Look, the president and the European Union, these are the two biggest trading partners in the world talking to each other. We'll get a deal done. I am confident we'll get a deal done.
Up next on the programme, the former Republican Congressman Patrick McHenry, live from New York City this morning. Good morning. Bramo said it. Julian Emanuel of Evercore agrees. FOMO has begun. In his note over the weekend, reflected by a lot of the research on Wall Street this morning, we think dips are meant to be bought. Mike Wilson and Morgan Stanley looking for another leg higher over at Deutsche Bank in this equity market. Here's your leg higher. Equity futures on the S&P, firmer by 1/3 of 1% on the Nasdaq, up 1/3 of 1% on the Russell. The small caps up by 0.6. Under surveillance this morning, pushing for a deal.
Look, the president and the European Union, these are the two biggest trading partners in the world talking to each other. We'll get a deal done. I am confident we'll get a deal done. Okay? And it will be great for America because the president has the back of America. So I think all these key countries will figure out it is better to open their markets to the United States of America than to pay a significant tariff.
Here's the latest this morning. The Commerce Secretary Howard Lutnick hopeful the US can make a trade deal with the EU before the August 1st deadline. Sources telling us here at Bloomberg that EU envoys are preparing to meet as early as this week to plan for a possible no-deal scenario. Joining us now is Bloomberg's Michele Gardner. Michele, welcome to the programme. Let's just focus on this relationship between the United States and Europe. What's the state of play?
Well, the EU was one of several countries that was surprised to receive these letters from President Trump, despite the fact that they've been in the midst of negotiations for weeks, if not months here. The president wrote to the EU saying that they will face a 30% tariff. And now we're 2 weeks away from that August 1st deadline. And these two counterparts, this bloc, which includes, of course, many countries that have different perspectives and making this a lot more complicated, frankly, for the bloc, and the U.S. are going to continue to meet going into this week. But some of the things that the EU is looking for is really restrictions on certain sectors like steel, aluminum, aviation, some manufacturing equipment, medical devices. But before this letter, they had assumed that potentially that they could see a 10% tariff. This is a much higher tariff number that we saw with the president's letter. And this is something that major trading partners are sort of having to expect now. They're going to expect these unbalanced agreements. Some countries have 0% tariffs, the U.S. much higher, and this potentially could be the case, and this is the scenario that the EU is gearing up for. And they have said from the beginning that they would retaliate if the U.S. puts tariffs that they are not comfortable with, and that is something that the U.S. is certainly going to have to expect, but it comes with a lot of risk, because we saw with China that the U.S. will retaliate. At one point, of course, China's tariffs were as high as 100%.
Okay, as we know, these are self-imposed deadlines and these deadlines can change. How seriously are trading partners taking that August 1st deadline?
Well, Commerce Secretary Howard Lutnick said yesterday that this is a hard deadline. He says that they're going to continue to take calls. They'll be open to negotiate after that August 1st deadline. But he says tariffs will be imposed on that day. And so if you take this Commerce Secretary at his word, that is the deadline. But of course, we've seen many times in the past that deadline has moved.
Michele Gardner of Bloomberg down in Washington. Michele, thank you. How seriously is this market taking this August 1st deadline?
Scott Bessent told us not to care about at least the one with regards to China, saying that August 12th deadline, we're telling markets, don't actually think about that so much. And we've seen it push back again. At the same time, does the specter of the taco threat kind of hang over President Trump? He wants to show that he's serious about his deadlines. And this is the reason why the market's just numb and going on vacation.
Well, if you are negotiating, you have to stick to your guns in order to get the most out of the negotiation. But what I would say is that what I've heard from trading partners, they say if they are at the tail end of these talks, they are basically being told by this White House, stay in good faith and we will let you extend, which basically means that every deadline that this White House comes out with is fluid.
Joining us now to extend the conversation, the former Republican Congressman Patrick McHenry, also the former chair of the House Financial Services Committee. Patrick, welcome to the programme, sir. Let's just talk about these deadlines and the posture of the White House right now, negotiating with trade partners all around the world. How seriously should we take that August 1 deadline?
I think it's been said already. I mean, two things can be true at once. The deadline is serious. It is meaningful. The market should cue to this. Trading partners should cue to this. But this White House has maximum leeway to extend. And each trading partner is in a unique position with the United States. And so much of that has to do with the individual tone of the negotiations that we are not privy to. It's done behind closed doors. Is a real question about the notion of goodwill. And the notion of goodwill is a judgment call. And so this complicates really what we're going to see over the next 30, 60, 90 days. And each one of the trading partners are in such a significantly different position in how those conversations have gone behind closed doors.
Well, when it comes to an ally like the European Union, you were in Congress alongside Speaker McCarthy when there was a lot of emphasis on the China Select Committee. Is there damage being done with all this job voting with allies like the European Union, like Japan, even though most Republicans want to see a firm stance when it comes to one country only, and that's China?
Well, I think you're seeing that President Trump has significant leeway among Republican legislators on Capitol Hill. Look, the Republican Party I got elected with 20 years ago was a free trading party. That has changed significantly over this time. This president has maximum authority and leverage with Republican legislators, and that's why you're seeing him get this long rope in negotiating these deals.
If the European Union, though, does come back and retaliate with politically sensitive goods like soybeans from Speaker Mike Johnson's Louisiana, will then we potentially see some Republicans dial the White House and say, look, we have some concerns about this, especially when it comes to the agricultural sector?
Well, they tried this. China tried this in 2018, 2019. This playbook's already been done. I think what these trading partners have done is dial this up significantly and trying to be very specific about the implications, the impact that they would have on individual states and districts. But I think there's a lot of pain that legislators are willing to take before they go against President Trump. So I don't think it's going to work out for these trading partners to do it. I think it's going to be far better to cue to what Secretary Bessent has said publicly, what Secretary Letnick has said publicly, is be of goodwill and you'll get good treatment. And I think that's what we need to listen to more acutely than these retaliatory measures that other nation states are listing out or making the threats that they will take these actions.
Patrick, you alluded to something there that I think is really up for debate among a lot of different publications and prognosticators, which is unity in the Republican Party. And you said that it does seem like Republicans will be willing to take quite a bit of pain before really speaking out against what President Trump is doing on trade. Do you think that there are signs of cracks in that unity in the Republican Party that have been growing over the past few weeks that are different and new and potentially have ramifications for some of these policy implications?
The beatings will continue until morale improves. No, I don't think there are significant cracks. I think Capitol Hill is much more chaotic right now to produce legislation than it's been in many years. But the results are there. The president got the crypto bill in the style and form he wanted, signed that on Friday. He got the one big, beautiful bill. He signed it on July 4th. He said he wanted to sign it on July 4th. He got to sign it on the 4th of July. I think he's getting what he wants out of policymakers on Capitol Hill. But in the fall, we have not only tariffs and trade to deal with, but we have a potential government shutdown. And negotiating through that is going to be quite a significant challenge for the administration and for congressional Democrats who have the ability to block government funding.
Patrick, appreciate your time, sir. We'll catch up again soon. The former Republican congressman there, Patrick McHenry. Republicans united on one issue, seemingly. This from Semaphore this morning. The Trump administration wants to visit the Federal Reserve this week to review its $2.5 billion renovation. Senate Banking Chair Tim Scott in talks to attend as well.
Well, is this the new way to sort of curry favor with the president to try to gang up on the Fed chair, especially if you have any interest in being Fed chair yourself or even, potentially just win political points? Why is this what we're talking about? Honestly, I just keep thinking about this. The Journal article, yes, this was something that President Trump dismissed. But realistically, the arguments that Scott Bessent allegedly made have resonance. They're going to cut rates. And what are you going to actually accomplish if you do kick him out?
The beatings continue. Coming up on the programme, Angelo Zino of CFRA as tech earnings kick off this week. Plus, we'll catch up with Danny Berger with your morning movers as Stellantis stalls. Live from New York City, you're watching Bloomberg TV. Equity markets doing okay. Futures positive by 0.25% on the S&P 500. On the Nasdaq, up again this morning by 1/3%. Banner Buwaiter of UBS with some pushback. It's the wrong reaction to look past these tariffs and move on. When the inflation impact comes through, hits real disposable income, that's when I think markets will begin to see this. There isn't much of it, but there's some pushback out there.
And it's coming at a time of valuations that are resonant of levels and types of speed that we haven't seen since 1999. We haven't seen it in the data yet. And a lot of people expected to see it by now. And because they haven't seen it by now, they're dismissing it as fiction. And that, I think, is one of the reasons why we have FOMO once again.
Will we see it in the earnings? More earnings still to come this week. On Wednesday from Tesla and from Alphabet. We'll talk about that in just a moment. 3 hours away from the opening bell. Let's get you some morning movers. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. We have a new entrance to the S&P 500, and that is Jack Dorsey's tech firm Block. A lot of passive money goes into stocks that are added into the index. You can see those shares up 9% in the pre-market. It will be replacing Hess, which finally, after 20 months of drama, was acquired by Chevron. Elsewhere, a little bit of sell-side action. Morgan Stanley upgrading both Etsy and Pinterest together this morning. Both those shares rallying 4.3% for Pinterest, 3.5% just thereabouts for Etsy, saying that valuations for both of them look attractive and trends are favorable for them for this earnings season, and that should be a catalyst for shares to go even higher. Now, the same can't be said for Stellantis in terms of good earnings. Was this the kitchen sink moment for the new CEO, booking a first half loss of nearly $3 billion, to be specific 2.7. Analysts had expected at least a small profit. That's not what we got. We got a glimpse into what the new CEO has to deal with going forward, everything from tariffs to expensive cancellations of some of their EV programs and lesser demand there. So those ADRs down 1.6%, John.
Too many brands, not enough focus. Danny, thank you. More from Danny in the next hour. Every single time we talk to the company, we had that conversation. Everything's on the table. Everything's still on the table.
Well, I was driving this weekend. I saw a Dodge. Who buys Dodge anymore? And I was thinking to myself, this is part of the problem. Why are we saying that when we see a Dodge, even though we're not saying that even when we see any kind of Kia, particularly Tellurides?
That one guy who you saw, basically.
But that one guy. But it was really noteworthy. It was more noteworthy than a Tesla or a Camaro or anything else. It was just notable.
Matt Miller as well, right? I think has a Dodge, doesn't he?
Does he?
I think so. I think I'll check in with Matt later. I'm sure he does.
Really?
Equity futures this morning then positive by 0.25%, very close to all-time highs. On our radar this morning, President Donald Trump disputing a Wall Street Journal report claiming Treasury Secretary Scott Bessent told him not to fire Fed Chair Jay Powell. Trump posting on Truth Social, quote, "People don't explain to me, I explain to them."
Noise versus signal. That's what I keep coming back to. Why is he rebutting this? Is it a point of pride? Nobody can tell me what to do. Nobody has to explain anything to me. I'm the smartest guy in the room. Or is this to keep the speculation ongoing to try to job on the Fed into taking some sort of position? That's the reason why the story isn't going away. The markets, though, have moved on, and that's what we're seeing today.
And when it comes to what Trump is talking about in this Wall Street Journal piece that he says is flat out wrong, no one needs to explain to him, is Scott Bessent laid out a number of issues impacting the economy, impacting the markets, the fact that they might just be cutting rates anyway, so you're going to get what you want, and also the legal hurdles. One thing, though, the president potentially wants to do is he wants a scapegoat for the fact that there was a poll over the weekend that about 70% of Americans do not think they are focused enough on inflation and bringing affordability back into place.
This market has moved on, to Lisa's point, moved on to looking ahead to 2026, according to Lori Calvasina of RBC. How can you look to 26 without resolving the policy issues of 2025? Here's one right here. The EU is heading into another week of trade negotiations with the US, but gearing up for the worst. Sources telling us here at Bloomberg, the bloc is preparing a retaliation plan to respond to a possible no-deal scenario.
And what you have right now in Europe is a lot of mixed feelings. You have France, which basically wants to say we're going to go as hard as using this anti-coercion measure and do some of the biggest retaliatory measures we can, put them on the table. Others, according to our reporting, are prepared to stomach an unbalanced agreement just so that they can get agreement in place, stop the uncertainty, and get numbers in place. And what the U.S. is looking at right now is potentially even higher than 10% and less carve-outs. Can Europe stomach that? That's the big question for the next 11 days.
The win is available to the U.S. and to the White House if they want to take it. Europe is ready to take something, accept something they weren't willing to accept only a few months ago. Are they going to take it or not?
You said that before, and I picked up on that. I thought that was a really astute point, especially because Howard Lutnick is saying they just want other nations to open up trade to the United States. Is that truly the goal? Well, the goalposts keep moving, and that's one reason why Europe is preparing for other outcomes. There's also the fact that local elections matter for international policies, and we keep seeing that, and that's very relevant for Europe and a number of other regions.
Well, let's talk about one of those regions. Let's talk about one of those countries, Japan. The Japanese Prime Minister, Shigeru Ishiba, is vowing to stay on after his coalition fell 3 seats short of an upper house majority, marking the first time since 1955 that a leader from the LDP will govern without a majority in at least one legislative body.
And it comes 11 days before that August 1st deadline that they're supposed to come to some sort of trade agreement, with Scott Bessent heading over to Japan right now to discuss it with a leader that's effectively been neutered. Right now, markets are breathing a sigh of relief that the worst case scenario didn't come to pass, where he was forced to step down. But you start talking about fiscal policy, you start talking about negotiations when it comes to trade deals, you start talking about the sea change that is inflation, and how much that has caused incumbent leaders to be kicked out of office again and again.
Policy gridlock used to be a good thing for markets. Some of the issues that these countries face now, is policy gridlock still a good thing for markets?
It's a tricky question, given the fact that the world is moving on. Policy gridlock is sort of a relic of a time that was more stable than the one that we're facing off with now. Right now, Japan is facing off a fiscal crisis, and if they start cutting taxes, watch out for those bond yields to surge.
That's the situation in Japan this morning. Let's turn back to tech. Tesla, Alphabet, kicking off big tech earnings this week. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, welcome to the programme. Kicking off Mag 7 earnings. What are you and the team looking for later in the week?
Well, we heard in the last 90 days that the GPUs are melting a few times. So, clearly that beat and raise is very important from all the cloud hyperscalers, especially Microsoft. I mean, clearly they are the biggest beneficiaries with OpenAI's models doing really well. At the same time, the CapEx increase. So our framework now is, if the cloud revenue grows by, let's say, mid 30%, then they will raise their CapEx by a similar amount, 30 to 35%. But from this point on, you will see a matching of revenue growth with CapEx growth. And that's the framework we apply to all of the hyperscalers except Meta, which doesn't have a cloud business. But you want to see that inferencing show up in the cloud revenue. And that's where I think Microsoft will do really well.
Mandeep, when it comes to Alphabet, there's a word that pops up all the time: existential risk. And what that company is facing at the moment, it's down on the year. It's had a big rally off the low. I think we're on an 8-day winning streak going into earnings at the moment. What kind of risk does that company face? And are they behaving in the same way that, say, Meta is and Mark Zuckerberg, which is behaving as if they face an existential risk?
Well, look at the numbers. So ChatGPT is now doing 1 billion queries a day. Compare that to an Alphabet, Google doing about 14 to 15 billion queries a day. So clearly, ChatGPT has made inroads in terms of the search query volume, but we know ChatGPT doesn't have an ad model. So from that perspective, Google still has a lot of levers to pull on the search side, YouTube side, and that will show up in the ad pricing this quarter, and you will see them at least post inline numbers on search. And all other segments should outperform, whether it's YouTube or Google Cloud or Waymo for that matter. But clearly, everyone is fixated on search because that's what drives the bulk of the free cash flow.
Mandeep Singh of Bloomberg Intelligence. Mandeep, thank you. No doubt we'll catch up with you on Wednesday and beyond. Angelo Zino of CFRA has a buy rating on shares of Alphabet, a 210 price target. Angelo, welcome to the programme. That ad model at Alphabet, how insulated is it right now?
Yes, thanks for having me, John. As far as kind of the ad model is concerned, I mean, listen, I think they're doing a lot of great things as far as what's going on across search as well as YouTube, integrating AI across the ecosystem. You've got AI mode ramping here on search, AI overviews. So overall, I think the monetization potential looks pretty good as far as their ad-based businesses and AI integrating across that ecosystem. Clearly there is a risk as we kind of go on here over the next couple of years. Eventually, OpenAI and others out there will probably have some sort of ad-supported models. And that is, clearly a risk here for Alphabet. So sitting here today, I mean, we do think their ads, Google's ad-supported businesses probably grow around in line with the broader digital ad market. Let's call it high single-digit growth. But, ultimately, as we kind of go into some of these forward-looking years, 2026, 2027, we're looking at the growth pace of, something like search to grow at about half the pace of the digital ad market, just because you're going to have some, increasing competitive pressures out there.
Angelo, are we underestimating the speed of the adoption of OpenAI, of ChatGPT, and some of these algorithmic models that some people find superior to the classic search model? I mean, I was listening to John and Mandeep talking, and I'm thinking to myself, I've known so many people over the past 6 months that have utterly transformed their workflow because of ChatGPT. Is the time frame a little bit faster, potentially, than what we're talking about?
I mean, potentially. I mean, I guess we'll see here. I mean, ultimately, people are doing search in a different way than they have historically. And but when we think about just overall what Alphabet has, across their ecosystem as well, I don't think it should be underestimated. I think Gemini is an enormously powerful tool. I mean, I'm personally a power user of Gemini. I do love the fact that it's across their entire ecosystem out there. There is an advantage out there to that. I think that Alphabet's getting extremely smart with Gemini. So, I don't think you can completely dismiss Alphabet specifically and what they're doing across the AI ecosystem. Not to mention their infrastructure, I think, is better than just about anyone else's out there. But again, that being said, I mean, maybe to your point with what OpenAI is doing with ChatGPT and others out there as well, there are going to be more options out there in the market. And that is something that I think, as an analyst, you can't underestimate, and you do have to factor that into your future assumptions. But we do expect, ultimately their ad-supported businesses to continue to grow. It's just not going to be at the pace that, maybe you're seeing from, the market here over time because of the broadening out and greater competitive pressures.
A couple of months ago, there was a skepticism on Wall Street about the amount of money that hyperscalers were spending on R&D, on CapEx. And there was this question of, are they overspending? Meta had said, we can't spend enough. Do you think this season you're going to see a rewarding by investors of companies that increase their CapEx spend dramatically? Or do you think that that's going to be treated with the same skepticism as a couple of months ago?
Well, I think what you're actually going to see this earnings season, I think you're going to see CapEx spending plans sustained and not increased. We actually saw Meta increase it last earnings season as far as their 2025 CapEx guidance. I think, Microsoft has actually done a pretty good job here over the last couple of quarters, essentially kind of flatlining the CapEx number, leveling it out. This is their year end, so we'll kind of see what type of guidance and outlook they decide to provide here for investors here over the next year. But I actually think, for the most part, you're going to actually see more favorable return ROI metrics across kind of some of these cloud providers because of how they're spending on the CapEx side of things. They are shifting more towards the server side of things here over the next couple of quarters and years. And clearly the growth pace is, starting to kind of decelerate and level out a little bit here. So I think kind of the return on investments are going to see considerable improvement here, not only over the next couple of months, but over the next couple of years. And I think investors will reward that, maybe to your point. I think the other important point here, or item to look out for here this earnings season, is something along the lines looking at the OpEx side of things, something that these companies have really been holding, kind of leveling out here over the last couple of years. Actually, if you look at employee headcount, whether it be from Google, Microsoft announcing recently some of their headcount reductions, essentially down over the last kind of 2 to 3 years, flat to down. And I think it'll be interesting to kind of see how all these companies comment relative to what we've seen here from Zuckerberg over the last couple of weeks and months. I think that's going to be really an important storyline as well.
Angelo, appreciate it. Angelo Zino there of CFRA. Big focus for us here at Bloomberg, doing more with less as some of the world's biggest companies.
At least fewer people, right? But is it less investment? And that's sort of the question. Meta's been a forefront leader in terms of cutting staff, but then increasing their CapEx. Is that repeated by others?
What happened to the year of efficiency? Now he's like going around like Stevie Cohen, collecting superstars.
Well, if he could invest in the Mets, I'd be okay with it. I do think, though, that going forward, there is a question of where you're investing. He tried Meta, that didn't work, so now you've got to invest in the physical infrastructure of the world and how that relates to technology, and that's where his mind really clearly is at.
A big week coming up for tech earnings. Equity futures right now in the S&P positive by 0.25%, with an update on stories elsewhere with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Israel has warned it will move into a town in the heart of the Gaza Strip for the first time. It had been avoiding this town for fear of harming hostages. Hamas, meanwhile, says almost 1,000 Palestinians have died while they were waiting for aid. Meanwhile, shares of Domino's Pizza are rising 5% in the pre-market. The company's second quarter revenue coming in at $1.15 billion, slightly above the average analyst estimates, with same-store sales growth in the U.S. driving revenue higher. Meanwhile, EPS came in lower than expected at $3.81. And Blackstone has pulled out of a bid for a stake in TikTok's U.S. operations. Sources telling us here at Bloomberg the firm has offered its potential share to other investors in a consortium that includes Oracle, Andreessen Horowitz, and General Atlantic. TikTok is facing a September deadline to find an American owner or be banned in the U.S. That's your Bloomberg Brief. John?
Yahara, thank you. The rolling 90-day deadline. TikTok extension after TikTok extension.
Absolutely. It just keeps getting kicked down the road when it comes to TikTok. It's like, are they ever going to come to an agreement? But potentially this is part of the grand bargain. So maybe it'll come to an agreement when Xi Jinping and Trump finally sit down.
The latest deadline is September. Up next on the program, the race to replace Chair Powell. Is it a position you would like?
If the president contacted me and said, I want you to serve, I would do it. But he's not contacting me.
That conversation up next with Skylar Montgomery-Koning of Barclays from New York. This is Bloomberg. A nice, quiet summer Monday.
Don't say that.
What's wrong with that?
It's just that we're so used to, this hyper-stimulation that you're trying to sort of dare the market into having some.
You're jinxing it. The second you say it's quiet.
I'm not trying to do anything. It's a nice, quiet summer Monday.
You know what you're trying to
Hopefully
do.
we get a nice,
You know what you've done.
Summer week.
You're trying to poke the bear.
Taking Friday off now. Just put that in the diary.
You are?
I am.
Oh.
I also
Equity futures on the
off.
S&P look like this. Futures are positive by 0.25%, up a third on the Nasdaq 100. Under surveillance this morning, it's the race to replace Chairman Powell. Is it a position you would like? Is it something you would like to do in the future?
If the president contacted me and said, I want you to serve, I would do it. But he's not contacting me.
We'll see if he does.
If he says, Chris, I want you to do the job, I'll say yes. But he's not talking to me, so that's it.
It's the latest this morning. Fed Governor Chris Waller in the mix to replace Fed Chair Jay Powell. Skylar Montgomery-Koning of Barclays writing an early start for a more dovish shadow Fed added to the greenback's woes. But in the last couple of weeks, there are signs of consolidation. Skylar joins us now for more. Skylar, good morning.
Good morning. Thanks
what
for
are
having
those
me.
signs of consolidation that you've got your eye on?
Yes, absolutely. So I think what markets were very worried about when you got Liberation Day was you had an unnatural correlation with the dollar and risk. I think the other part of the picture was there was this worry that tariffs would be very negative for the U.S. relative to the rest of the world because the U.S. was picking a fight with everyone would fight back. What we've seen instead is that countries have not retaliated, so that's less of a U.S. growth impact. And if you think about what economies will be most under pressure from tariffs, it'll be your small, open, export-oriented economies. And Europe is not small, but it's very open. And so I think now we're having more of a normal correlation where tariffs are seen as more positive for the dollar than maybe previously.
And you see good reason for that to continue?
Yeah, I think so. I think part of it will be a reevaluation of what we're seeing from a growth perspective in the U.S. So I think we had a lot of front-loaded weakness in the dollar in the first half. That looks like it's hard to continue. I will also say there seems to be this asymmetric reaction function that we had in the first half where, dollar bad news was very bad for the dollar, whereas good news was not as good. And so stuff like fiscal, which could be taken as a negative in terms of deficit expansion, Section 899, or a positive in terms of it's a small growth impulse, was very much shaken on the negative side. But we haven't had some of those negatives feed through, right? The deficit expansion isn't as bad as we thought it would be. Section 899 has been removed. But because we had that weakness, you've had some kind of premium priced in. So there's room for that to come off as problematic policies have come off.
We dealt with trade. Now let's deal with Fed independence, right? It's sort of whack-a-mole. Which issue are we actually talking about when we talk about the dollar versus the euro? Is the level that we're looking at 116 on the euro-dollar cross, including the potential for a Fed that is disproportionately dovish in response to some of the jawboning from the president?
Yeah, I think there's definitely some kind of a premium priced in terms of a removal of Powell as Fed chair. That's certainly not. I think we saw that clearly in the market reaction function last week, where you saw a strong dollar sell-off when there was a high risk of that. What I would say is, it's clearly unambiguously dollar negative, right? It means that the risk is you have inflation de-anchoring. Buying the dollar, buying U.S. assets is a commitment to buy something that will likely only devalue by 2% per year, which is what the Fed mandate means that you're getting from that. So it is clearly negative. I think the issue is it's hard to actually remove Powell legally, as well as there are 12 Fed governors. So the market's very aware that if Powell is removed even, which seems low likelihood, then you have 12 other or 11 other governors who might not turn that way and likely won't if the data doesn't support it.
Are we close to the threshold of people getting sick of being bearish in the dollar? This idea of the consensus trade, the one consensus trade in the first half of 2025, maybe coming under some pressure?
I think absolutely. And we've seen that in positioning data. So we look at both CFTC, options, and then sentiment. And that had this massive roller coaster this year where it was very bullish, then very bearish. And it's kind of neutralized now. I think part of the story, too, is that there's not a good alternative. It's not like Europe has this great growth story going behind it. If you think about the optimism that was priced in on fiscal, that's largely gone away, especially when you consider that for our 2026 growth forecast, the negatives you get from tariffs for growth are much more negative than the positives you get from fiscal.
So what is it capped as? What's the level it's capped at when it comes to euro dollar?
Yeah, in euro dollar, I think, 120 is the max you can get. Obviously, we're quite a ways from there. But in our outlook, we looked at kind of how you get there. And what I will say is we haven't seen flows broadly move away from the U.S. There's not been this mass exodus from U.S. equities. There's not been a mass exodus from U.S. fixed income. What you have seen is hedge ratios have adjusted. And we've undone quite a lot of that hedge ratio downward trend that you got when the Fed was hiking. And you could certainly have that hedge ratio adjust higher to the detriment of the dollar versus the euro and towards 120. The issue is hedge costs are very correlated with hedge ratios. So if that cost stays high, if the Fed stays where they are, you need continued catalysts and reasons to pay that cost.
Building on Lisa's point, though, about the question of an independent Fed and the president continuously bringing up whether or not he's going to fire Jay Powell or not, what is the long-term damage that could do to the dollar?
Yeah, I think the worry is around the institution, whether or not you get erosion there. And we've definitely seen this not just with threats to the Fed's independence. I think this was also part of the Liberation Day dollar sell-off. I think the hope is that overall, when you're thinking about policies from the U.S. administration, they're thinking about growth positive policies. And so that would be more positive for the dollar. But certainly it brings up questions that we haven't been thinking about previously. That means that maybe at the margin, you get this de-dollarization, which I think the case is still very out in the long term as to whether or not investors will broadly turn away at the margin from the U.S.
ECB on hold this week?
Yes, I think that's pretty well expected. I think the question from here is whether you get further easing. And I'd highlight that you're going to see inflation divergence between the U.S. and Europe, certainly. So the U.S. has a price level adjustment at a minimum from tariffs. You also have tighter immigration. And you have the dollar decline in the first half will be an inflationary boost, too. On the other side, you have weaker currencies in the Eurozone. Oil prices are much lower. You've got this oversupply from China that needs somewhere to find or some home to find. And you also have a euro that's much stronger, which is disinflationary on top of weighing on exports. So you could see more cuts, certainly.
Green light for them to cut rates if they want to, but no one believes they will this week, at least.
Everyone expects them to remain on hold for quite a while. I'm waiting for someone to ask Christine Lagarde, is this because you want the euro to become the reserve currency of the world? And is this the way that you plan on supporting it going forward?
A global currency. Is that what she's called it, I think?
Yeah, she said this is her opportunity. Step up, guys.
So the ECB will be a snooze on Thursday, so take Thursday off as well. Skylar, thank you. It's good to see you. Skylar Montgomery-Koning at
Anything
Barclays.
else?
I'm just trying to wrap up the week. See that story about 24/7 trading?
Yeah,
No,
exactly.
Thank you.
I know.
Absolutely not.
Yeah.
Bob Michele at JPMorgan Asset Management joins us shortly, alongside Charles Mars of Signum Global Advisors, Eric Mogelof of KKR, and a whole lot more.
It is kind of a murky data picture.
We need to be careful of some of these cracks in inflation data.
There are certainly signs that the labor market is more fragile than it looks.
What we're really waiting for is this pass-through of inflationary impact.
I really don't know that we're at the cusp of something dramatic happening to this economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and this rally resumes. Equity futures on the S&P 500 up by 0.25%, building up to the gains on the Nasdaq 100 up another 1/3%. Through the week, a sprinkle of economic data and two earnings reports to keep your eye on. This coming Wednesday, Tesla and Google kicking off earnings for the Mag 7.
And this really will be the key week, the second fastest week or the second most active week for earnings reports on the S&P 500. And we get a sense of how well the big tech giants are actually doing. Do we get a sense that they're going to exceed expectations as much as they have in recent quarters? And is that enough? We have seen this time and time again. As the bar gets higher and higher and higher, their projections that blow it out of the water still are not good enough. We saw that with some of the banks. Do we see a similar type of reaction from the tech giants?
Tech, AI in its own world. American Airlines later this week. You spoke to United Airlines just last week. They're talking about a second half rebound. A second half rebound. Lori Calvasina of RBC was discussing this. Investors now focused on 26, looking past all of this headline risk through the summer.
Yeah, although airlines seem to be in a world of their own, and she actually talked about that in some of her notes, how their optimism about the rebound in travelers and consumer spending seems a bit divorced from what we hear from other consumer-facing outlets that show a more tempered or sideways type of market. Does American show the same trend, given that they still also have a big business component to their travel in front of the cabin? We also hear from Southwest. Do we see a deterioration in other more vacation-oriented plane services? And that, I think, will give you a fuller picture of the whole airline sphere.
I mentioned those trade deadlines, August 1st. August 1st, the self-imposed deadline, which can move, of course. The EU is taking that trade deadline very, very seriously, preparing for the worst and preparing potentially this week retaliations.
Preparing to retaliations. Also, Jonathan, preparing to potentially just accept an unbalanced trade agreement, because any trade agreement at this moment for Europe might be better than not having one on its own. When it comes to what they could retaliate on, there's two separate lists. One's going after things like soybeans, agricultural in the United States. The second one, more important to the U.S. industrial complex, things like Boeing. And then there's a third they can go into, is this Anti-Coercion Act. That would be the nuclear option. You have individuals in France pushing for that, but others are saying, wait, steady, hold the course, let's get to the finish line when it comes to August 1st.
I thought we had a deal. The EU would accept 10% tariffs, a couple of exemptions on some key industries, and we move on.
You know, Scott Bessent, when he was on with us, said something that I thought was really instructive. He said, either way, President Trump wins. Either we get more revenue from tariffs or potentially we extract a better deal. What is the end point of that type of psychology? When is enough when you have a certain type of concession? That's what I'm curious about.
You enjoying this snoozy Monday morning?
Sort of. I mean, I feel like
July
we're all
21, nice and quiet.
The problem is, you know how like a computer, when you click on it too much, it just starts buffering? I feel like I'm still buffering from the rest of the year, so that's kind of where I'm at this morning.
That's your morning. Mine too, you're not alone. Equity futures on the S&P, positive by 0.25%. Coming up this hour, Bob Michele of JPMorgan Asset Management expecting growth to slow. Charles Mars of Signum Global Advisors on the feud between Trump and Powell. Plus, Frankly of HSBC on his outlook for the chip sector. We begin this hour with stocks rising. Bob Michele of JPMorgan Asset Management writing the following. The full impact of tariffs has yet to hit. The inevitable reset higher in prices will see some demand destruction from businesses and from households. Bob joins us now for more. Bob, good morning.
Good morning.
Why haven't we seen much of it so far?
Well, I think that's been the amazing resilience of corporate America. Somehow they've been able to absorb the first round of tariffs in their margins. It's clear that the tariffs are being charged because revenues to the Treasury are going up. When you look at corporate earnings, they look okay. And when you look at inflation indices, those have been relatively moderate. So where have the tariffs been hitting? It looks like for the second quarter, corporate America absorbed a lot of them. Can they do it in the third quarter? It feels like the administration is solving for a higher tariff level, dare I say, to go from $2.8 trillion to something closer to what the One Big Beautiful Bill Act is, $3.4 trillion. So there's that perfect offset. Probably, I think corporate America has a lot more difficult decisions to make this quarter.
Is that positive for bonds or negative for bonds?
Well, bonds have also been phenomenally resilient. Nothing has gone right for the bond market. Tariffs are higher prices. The One Big Beautiful Bill Act means that there's higher growth, which will support higher inflation. Then you start looking at the rebalancing talk away from America, sell America. That noise still continues. And then you have all the global issuance. Yet here we are, 4 3/8% on the 10-year Treasury, flat to the Fed funds rate. It's not at 5%, probably where it belongs. I think the bond market absorbs it all. I think, like the Fed, it looks through the higher price levels and thinks about the impact to the broader economy and sees the economy slowing down. Not to recession, but we've got somewhere between 0.5% to 1% GDP over the second half of this year.
You've been a big bond bull. You just said that you see 10-year yields somewhere closer to 5% on a real level or based on all of these trends. Why do you think it's not? You talked about the idea that maybe people continue to buy bonds for yield, but does it make you nervous that maybe they're not counting for certain types of strength in the corporate resilience?
Okay. I don't see 10-year yields at 5%. I think they belong at 5%. And that's the great puzzle, that they're not there. Once the Fed stopped cutting rates, a natural resting spot for the 10-year should have been some spread to the Fed funds rate. And yet we've hung around 440 for eternity. That's telling us that there's constant demand for government bonds. There's constant demand for the bond market out there. Every time I meet with investors, they're trying to figure out where to get into the bond market, how to get into the bond market. They've got too much cash and they're trying to get in. So I don't think I'm going to get the 5%. I would have liked it to have had an opportunity to buy. I think you may get some indigestion. August, September, usually months for consolidation across markets. If we get wider credit spreads, maybe that's an opportunity to add some credit. But I don't think you're going to get the big sell-off in the bond market.
Well, you said that you do expect there to be some ramification from tariffs. One of the ramifications that people have believed there to be is the potential for inflation. If the Fed cuts benchmark rates by 25 basis points next week, Chris Waller would like that to happen. How much do you see the long end selling off?
So I wouldn't advocate a 25 basis point rate cut next week. I'm not, of course, auditioning for the head of the FOMC. So I'm not pushing for rate cuts. I think the Fed is right to just stay on hold, see where tariffs actually settle, then look at the impact to inflation, and then look at the labor market. And I think that's correctly what they're rightly focused on. This time they're going to be right. Inflation will be transitory. What is the greater impact to the labor market? If you start to shoot above 4.5%, then I think they will step in and cut rates to try to stabilize the economy. And then, of course, that puts a lot of chips on betting that inflation will come down early next year.
Bob, what if we never get to the end tariff story? We could be constantly negotiating the rest of this year.
Well, that's almost the ideal situation for the markets, right? You're dealing with a 10% base rate. You're dealing with some higher tariffs across different parts of production. You've got a lot of carve-outs. And when you step back and look at the economy, the market has absorbed that. It's okay. Corporate America can adjust to that. Businesses and households can adjust to that. And the markets are embracing that and saying, okay, that's moderate growth, moderate inflation, not so bad.
Is it fair to call the case to cut interest rates just an audition? Is there nothing credible in the argument for you at all?
The only thing credible for me, the only weakness that I see, and the labor market I think you can put to the side a little bit for now, because there's a lot of anecdotal evidence.
Well, that's the epicenter of the argument coming from Governor Waller. It's the weakness in the labor market that's coming together.
Okay, that can be his argument. But you're in the lows, 4% in unemployment. You haven't seen the real impact. For me, it's the housing market. That's the one thing that tells me that rates are moderately restrictive. You've got a shortage in housing. You've got a lot of demand out there, but housing affordability is at one of the poorest levels in history. There are three components of that. Home prices aren't going to come down. Real wages are going up, but it will take a couple years to catch up to where home prices are. The third is mortgage rates. Mortgage rates just below 7% make the housing market unaffordable. If you bring mortgage rates down, I don't know, it doesn't have to come down 2%, a half, 0.75%, I think you see a pickup in new and existing home sales. To me, that's the key sign that the housing market, that the current rate policy is restrictive.
Key question here is just whether or not there is inflationary pressure in the system enough that if the Fed were to cut rates currently, that would lead to a reacceleration. It would lead to something that maybe wasn't transitory. And that's the reason why I asked if the Fed were to cut by 25 basis points or 50 basis points this year, or even more, would that cause the belief of a reacceleration of inflation to get baked into the market, making mortgages less affordable, right? I mean, that's the key question. Yeah. So what's that tipping point at which rate cuts are counterproductive to what we're seeing at the long end of the yield curve?
Well, if you start lobbing in 50 basis points now because you're saying, hey, we all agree on the FOMC that around 3% is a neutral rate. We're at 4 3/8%. Let's go for it. Let's start throwing in the 25s and 50s and get down there. And yeah, you start to bring rates down like that. I think that will give corporate America a sense of confidence to push through a lot of the tariff pricing to the consumer. Right now, they're weighing how much do they absorb, how much does the consumer absorb, how much do they make the exporters absorb. They'll push more of that through. Then consumers may choose to finance that. They may take out a bigger mortgage. They may go ahead and take out a bigger car loan. We'll have to see. But the real problem is if that becomes embedded in wages. We don't see that yet, right? I talked about low fours are pretty much full employment. John made the point that, hey, it's been rising. That's the center of the storm out there that people are talking about. The Fed should be cutting rates. So if that's true and unemployment has been going up and people are concerned about the stability of the labor market, you're not going to see a price wage spiral. You're not going to see wages shoot up like that.
Bob Michael of JPMorgan Asset Management. Bob, thank you.
Pleasure to be here.
A nice, quiet summer Monday. Next Wednesday, if this week's going to be a snooze, and I think it might be, based on this morning so far, next Wednesday won't be. A week on Wednesday, a Federal Reserve decision, and that one could be interesting.
Expect dissents. I think that's what we heard from Fed Governor Chris Waller, that he is ready to dissent on the consensus position that they're going to hold steady and prepare for a rate cut in September. He'd like to cut as soon as next week. And the why is going to be important. How do they justify how this is not political and this isn't just an audition to be the next Fed chair?
Equity futures on the S&P positive here by 0.2%. With an update on stories worldwide with your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. President Trump is pushing back on a report that Treasury Secretary Scott Bessent warned him against ousting Fed Chair Jay Powell because it would be bad for markets. But in a post on Truth Social, Trump called the Wall Street Journal, quote, typically untruthful, and went on to say he knows better than anyone what's good for markets. Meanwhile, a Delta Airlines jet was forced to abort landing to avoid a mid-air collision with a B-52 bomber. The incident happened last week in North Dakota near an Air Force base. Citing the pilot, ABC News reported the plane had to make an aggressive go-around maneuver as the other aircraft became visible. ABC News says afterward, the pilot apologized to passengers. And sticking with the airlines, Alaska Air has resumed operations after an IT outage temporarily grounded its fleet on Sunday. The grounding lasted about 3 hours. It's the second time in just over a year Alaska Air has had to ground its fleet because of IT problems. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, the feud between Trump and Powell.
The president is an amazingly transparent person. When he thinks something, he says it. So he says, look, this guy's doing the worst job. We have interest rates the same as Gabon. Whether he decides to let Jerome Powell stay in the job or not, I'll leave that to Donald Trump.
Rate differentials are important. I'm not sure about that rate differential, but rate differentials are important. Charles Mars of Signum Global Advisors joins us next, live from New York City this morning. Good morning. From New York City, welcome to the program. Just short of all-time highs going into the weekend, looking for another record high as we begin a new trading week. Equity futures positive by 0.2% on the Nasdaq 100, up by 0.25. Under surveillance this morning, the feud between Trump and Powell.
The president is an amazingly transparent person. When he thinks something, he says it. So he says, look, this guy's doing the worst job. We have interest rates the same as Gabon. Whether he decides to let Jerome Powell stay in the job or not, I'll leave that to Donald Trump. I think the guy's doing the worst job. He's costing us, you and me and the American people. It's just wrong. I don't know why he's torturing America this way. Our rates should be lower.
It's the latest this morning. President Trump disputing a Wall Street Journal report that Treasury Secretary Scott Bessent advised him against firing Fed Chair Jay Powell due to the market reaction. Trump posting on Truth Social, if it weren't for me, the market wouldn't be at record highs right now. It probably would have crashed. People don't explain to me, I explain to them. Bloomberg's Michele Gardner joins us now for more. Michele, welcome back to the show. We caught up with the Treasury Secretary Scott Bessent just last week, and he acknowledged the formal process to replace Chairman Powell had started. Can you help us all understand where we are in that process and how soon we'll find out who will be the next Fed chair?
Well, the conversation about whether President Trump would fire Fed Chair Jerome Powell is far from over, and that is in part because the administration is looking into the Fed's renovation building projects. They say they have a $700 million cost overrun for a project that was initially valued to cost less than $2 billion. It's now surpassed the $2.5 billion mark. But Fed Chair Jerome Powell responded to questions from Budget Director Russell Vought last week and said essentially that they've ordered the independent inspector general to take a look at the cost overruns. They are also blaming inflation potentially on the rising costs, but essentially said there's nothing to see here. There's nothing nefarious happening. But President Trump has floated the idea of potentially fraud being involved here, which would be a criminal offense. No evidence yet of that. But the administration is planning a visit to the Fed's properties to look at these renovations. It's really unclear what will come of that, but there's already a race to replace Jerome Powell, whether it's this year or at the end of his term in May 2026.
Michele Gardner with the latest down in D.C. Michele, thank you. Michele mentioned that visit to visit the Federal Reserve HQ. Senate Banking Chair Tim Scott also in talks to attend as well, according to reporting from Semaphore earlier this morning.
Yeah, to me, it's sort of the political hot potato. Who can you blame? You know, I got sucked down a rabbit hole looking at Gabon and the national parks in Gabon.
Is that how you spent the commercial break?
4.5% interest rate?
100%. They've got 4.5% interest rate. And I have to say that they've got gorillas and dolphins. and I mean, I'm just thinking, like, you know, it just sends me on this rabbit hole of where in the world are they thinking of today?
We've got 60 seconds here to talk about this. The administration has a rather unique way of thinking about interest rates in ways that maybe central bankers don't.
They think of it like credit risk, the Microsoft or Apple's. If you have an incredible credit worthiness, you should pay lower rates. While the rest of the world looks at it as a measure, some sort of approximation of growth and inflation. If that's the case, the interest rate should be higher. In the developing world, it's credit. In the developed world, it's sovereign. Do you really want to flip that on its head?
It's an interesting point of tension that isn't going anywhere anytime soon. Charles Mars of Signum Global Advisors has this to say. Our base case has been and remains that US President Donald Trump will not dismiss Fed Chair Jerome Powell, at the very least until after the September FOMC meeting. Charles joins us now for more. So, Charles, you've given us the best case 2 months. What happens after that if they haven't reduced interest rates?
Yeah, if the Fed doesn't cut at the September meeting, I think the president moves forward with a shadow chair nominee announcement and continues to build the case to dismiss Powell for cause, hoping that Powell will resign. I don't think Powell will resign, but I think that case will continue to be built. What the president really wants is for the Fed chair to resign, and Powell's not going to do that most likely. And the other part of this process is the president really trying to socialize with the markets this idea of replacing the Fed chair. The only guardrail working in the United States today in terms of a check on executive power is the bond market, and I think that's what they're most worried about. So the September FOMC meeting is critical. And we'll see what the Fed does. Otherwise, we have a shadow Fed chair.
Well, wouldn't it be even harder, though, for the collective body of the FOMC to cut if he was to get rid of the Fed chair, or say he was going to fire him after the September meeting?
Absolutely. I think, everyone in the markets understands that it's a 12-member FOMC vote. It's not just the Fed chair. But the president sees Powell as the obstacle, and he really wants a Fed chair in, whether it's shadow or if Powell resigns. Even if Powell resigns, by the way, the FOMC picks the Fed chair. So I think what the president's really doing is using Powell as the punching bag for higher rates. He's also worried, I think, that even though the administration doesn't believe that tariffs will be inflationary, that if inflation does pick up over the next several months, you can blame the Fed, blame Powell. But ultimately, I think this shadow Fed chair idea, which even 3 or 4 months ago sounded really far out there or deeply concerning for the markets, is now being socialized and probably happens after September.
Well, the Treasury Secretary talked about the fact that there could be confusion with the shadow Fed chair if Jay Powell doesn't step down after his chairmanship is over, but he still has a governor's seat until 2028. Do you have any indication that he would stay the course until 2028?
Absolutely. I think Chair Powell will stay on the board after his chair term ends, and he stays on the board until the end of his term in 2028.
But wouldn't that look very political, Charles? Charles, that would look incredibly political. Most chairs step down.
Absolutely. But I think it would be a really strong statement by Chair Powell, encouraged by some of the other members of the FOMC, perhaps, as a statement of very strong independence. And that's why I think he stays on.
Charles, there's a question of what happens if, let's say, Chair Powell is fired. And for cause, gets mired in all sorts of legal disputes. There's this issue of, does Congress confirm whoever President Trump nominates to replace him? How much unity is there right now among Republican Congress members?
Well, I think, whoever is nominated has to be confirmed in the Senate. The Senate, including the Republican caucus and the Republican leadership, do take Fed independence very seriously. So whoever's nominated will be a very respectable and acceptable and very positive person for the markets. It'll be one of the folks that are auditioning very publicly for it. But in the end, I don't think that's going to be the issue. That person will get confirmed. The issue is, will they try to sway the FOMC to be more dovish?
Charles Mars of Signum Global Advisors. Charles, thank you, sir. Looking forward to the Game of Thrones over the next 12 months or so.
Are you?
None of us have got a direct line into Chairman Powell and what he will or will not do with that seat. But ultimately, if it is a credible candidate, I think most people would assume on Wall Street he'll step aside.
Because ultimately, that is the tradition. That's what they would do. And to Annmarie's point, I think it's a valid point. It would be viewed as sort of thumbing his nose at President Trump to not let him have that extra seat, which then starts to become this question of, is he trying to hold rates high in order to have a political move?
As far as I can understand, between conversations, people in the administration, also reading the tea leaves, the issue is he has yet to tell them. He has yet to tell the president. He has yet to tell Scott Bessent whether or not he is going to step aside. And they need to know, because why? They want that seat, because they know that this is a collaborative body and that they want that seat to make sure they could put individuals with their worldview into the FOMC.
They want to plan that line in the sand then for Charles at least September 17th. They could be cutting interest rates by then. Based on communication that we've had from this chairman, from this whole FOMC, it looks like they'll be cutting interest rates by then.
It feels a little bit, I just have to say, the whole question of whether he stays on. It feels like if you have a kid who's 6 and they want some toy and they don't really want it and you're like, no, you can't have it, then they really want it and they're going to hold on to it forever and they're going to demand it.
You've got to have leverage.
Well, for what, the toy?
It's got $1 million speeches to give after this.
Yeah, you're not exactly
Keep that seat.
whipping out the
violin.
I wouldn't, but hey, all right. Up next, Eric Mogelof of KKR saying 401ks investing in private equity would be a game changer. That's next. Coming off the back of a week of gains on the S&P 500, just short of record highs going into the weekend. This morning, equity futures shaping up as follows. Futures positive by 0.2% on the S&P. On the Nasdaq, up by 0.25%. As we wait for earnings season to kick off for the Mag 7, look out for Wednesday when you'll hear from Alphabet and from Tesla. With 2 hours into the cash open, let's get you some morning movers. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John, we've already got a handful of earnings to work through. Just this morning, Stellantis off the lows of this morning. Originally, when it started to trade in Europe and the ADRs, that's what you're looking at in the pre-market, it was down sharply, now down just 0.2%. The thinking is perhaps this quarter was a kitchen sink moment. They recorded a $2.7 billion loss. The expectation was a profit. It's a new CEO who has to deal with everything from tariffs to shutting down some expensive EV projects. Meanwhile, at the top of this hour, we heard from Verizon. They narrowed their guidance for EPS growth for this year. Originally, they saw 0 to 3%. Now they see 1 to 3%. That's off the back of thanks to what they say are tax reforms, better performing businesses, and they're also able to increase their costs of their wireless business. So those shares up just under 5%. We also heard from Domino's Pizza. They reported at the top of the last hour, those shares are up 6%. They beat on same-store comparable sales for the second quarter. They also opened up more stores, both in the U.S. and internationally. The CEO saying that they are a value offering. And right now, as there are macro uncertainties, that's what customers want. They also apparently launched a stuffed crust pizza, which I didn't realize they didn't have one. So maybe that helping things in the second quarter too, John.
Corporate America getting it done in many ways. Danny, thank you. Bramo's face then on the prospect of a stuffed crust pizza from Domino's.
Sounds like
that was special.
Stop revealing what I do when you're not looking at me.
That was special.
Okay,
on our radar this morning. I'm going to move on. Don't
Does that
worry.
sound good to you?
It's not something I would eat.
Okay, well, let's see your face.
No, I'm not pulling faces, though. President Trump denying a Wall Street Journal report that Treasury Secretary Scott Bessent talked him out of firing Fed Chair Jay Powell. Writing this on Truth Social, people don't explain to me, I explain to them.
Basically saying the Treasury Secretary didn't have to come in and explain to me the impact of what firing Fed Chair Jay Powell would do, almost admitting that he knows the implications could be negative when it comes to the economy and the market. Still, to this point, the president is going to continuously go after the Fed. First, it was about Jay Powell and cutting of interest rates. Now it's about the renovation projects we've been talking about all morning. They're making a field trip over to the building, some Republicans and probably Ross Vaught, to see exactly what those renovations look like that actually are over budget, but the Fed says are in line basically with what's needed from this building from the 1930s.
Unpopular view. I'm sick of this story. I'm really sick of this story.
I think it's going to be.
I mean, I know, but it's just
what makes
long
you think
days
that's
ahead.
An unpopular view?
Well, I just feel
think
like
that's overwhelmingly
I just would like
popular.
to just move on. And ultimately, we know that he's trying to find some excuse because he wants interest rates to be lower. President Trump is a real estate developer. What a shocker. There is an unconventional view of why he should lower rates. You can blame inflation then. You can blame potentially any kind of slowdown. You can blame everything on this guy. Okay, this is what we're going to be talking about.
Also an argument out there over the last week that it's just one big distraction from other news dominating Washington
Like what?
at the moment.
Yes, exactly. Well, this is something that people have talked about, the Epstein files and what that actually does.
Also, I cannot get over the polling over the weekend. 70% of Americans say they want this administration to focus on affordability. Well, when you're talking about inflation, there's one prime suspect that you can blame if you're not going to blame this White House. You can blame the Fed chair, and that's what they're doing.
That's the latest stateside. I just want to fold in some news out of China. China reportedly stopped an American citizen who works for the U.S. Commerce Department from leaving the country for several months. The Washington Post reporting the Chinese-American individual had traveled to meet relatives in the country.
And this is something that we saw with the Wells Fargo employee recently as well. And it raises a question about what type of travel bans end up being used as some sort of negotiating chip ahead of a Trump-Xi meetup. The idea that in the United States, if everything is on the table, well, in China, everything could be on the table, too, including potentially preventing exits from travelers from the United States, raises questions about international companies and how they do business in the region.
Programming note, if you're about to fly this morning before we move on to our next story, might be flying to China, I've got no idea. Just cover your ears for a second. A Delta Airlines jet forced to abort landing to avoid a mid-air collision with a B-52 bomber in North Dakota on Friday. This is shocking. ABC News reporting the pilot called the go-around maneuver aggressive. and then apologized to passengers after landing.
Yeah, it sounds like it was just a nosedive and then a spike upward to try to avoid this military plane, Minot, in North Dakota, which is where this plane was flying to. Kind of separated from anything. That whole region is pretty much separated from anything, home to a huge U.S. Army and Navy base. And it raises a question about how much there is cross-communication. Again, the idea of traffic control, getting it up to speed and the investment that's necessary, that's something that we're going to be talking about on an ongoing basis.
Incredibly scary and shocking. And there's a video posted on TikTok, and the pilot can be heard saying, basically going through what happened. He said the aircraft was, quote, kind of sort of coming at us. Nobody told us about it. This is scary stuff. Can you imagine being on that plane and this pilot trying to navigate this? And once again, center stage, headline news for Americans is whether or not it's safe to travel.
All I can say, congratulations to the pilots. They did a great job.
Big time.
Yeah, I think that's pretty impressive.
Because hard pass from all of us, that's for sure. Let's turn back to markets. President Trump finalizing an executive order that would pave the way for 401k retirement plans to invest in private equity.
We've heard a lot of input from both the investors who want access to the private markets and to those sorts of products, and obviously from the people who are producing the products who are out to meet that demand. But we have to do it carefully, I think, because of course the private markets are a lot different than the public markets.
Eric Mogelof of KKR calling the move a potential game changer. I'm pleased to say that Eric joins us now for more. Eric, good morning.
Good morning. Thanks so
Why
much
would
for having
this be
me.
such a big move from your standing?
Look, obviously we'll need to see what happens, and we'll need to see whether we see the executive order, whether we see legislative and regulatory changes happen. But if we do, it could make a meaningful difference to the U.S. retirement market. Look, we have to acknowledge the fact that the U.S. has a real problem in retirement. There are millions of Americans that are relying exclusively on 401k plans. And the good news is they're living longer, but the challenge is they have a limited toolkit to enable them to retire with enough income. Conversely, if you look at other millions of Americans that are covered by defined benefit plans, they've been benefiting from private markets for decades. We at KKR, we manage private assets that benefit over 21 million retirees across public pension plans. And so our view is, why wouldn't you want all Americans to have the ability to have that full toolkit so they can retire with dignity?
If I were being cynical, which of course I'm not, I would speculate that maybe some of the premium has already come up from private equity. The gains have been got, and that's been from some of the big institutions. You started to see private equity returns lag behind some public markets. How do you make the argument that this is actually going to be beneficial to potential retirees rather than just getting in after it's already good and sort of picking up the pieces afterwards?
Sure. So we see the private markets growing substantially. And if you think about it, the public markets, publicly listed companies have been shrinking. A decade ago, there were 7,000 publicly listed companies. Today, that number is less than 4,500. We see really significant opportunities to put capital to work to generate strong risk-adjusted returns. And in fact, we see tens of thousands of financial advisors allocating to the private markets to enhance returns, diversify risk, and gain exposure to parts of the market that they otherwise wouldn't have access to in the public markets.
We've heard a lot about the potential looking outside of the United States, especially as some of the policy headlines that we're talking about just moments ago continue to percolate. How much is that true of private markets as well?
Sure. So as we look across our client base, across institutional investors, insurance companies, family offices, and wealth investors, we are seeing investors diversify across the globe. As it relates to our institutional clients, we are seeing them allocate more to infrastructure, both here in the U.S. as well as abroad. As it relates to insurance companies, as an example, we're seeing them massively increase allocations to private markets, in particular private credit, both here and in Europe. And so we do see investors slowly start to allocate across not just the United States, but outside as well.
What's the most popular when it comes to other areas outside the U.S.?
Sure. It really depends upon the underlying investor and what they're trying to accomplish. So, for example, within the institutional space, we are seeing more and more pension plans, sovereign wealth funds allocate more to infrastructure. And there it's in the developed markets, in particular, U.S., Europe, a little bit of Asia. As it relates to insurance companies, there we're seeing the focus in asset-based finance as well as private corporate credit. And there it's primarily in the US and Europe.
You keep talking about infrastructure. This speaks to the sort of industrial revolution 2.0 that a lot of people keep talking about. What type of infrastructure? Is this just tied to tech? Is it bridges and roads? Is it the air traffic control stations that we keep talking about?
Sure. Look, the two areas we see the greatest demand from our investors are in digital infrastructure and energy transition. Both of these areas are benefiting from secular changes, which are requiring trillions and trillions of dollars of capital, whether in digital as it relates to AI or in the energy transition as we move from brown to green. We're seeing substantial need for capital, and private investors are filling the void.
Can you just describe the kind of opportunities in that push that you're offering people that I can't get in public markets right now?
Sure. If you were to look at, broadly speaking, in the private markets, there are certain areas of the market that you otherwise are not getting exposure to. So just take, for example, in the public markets. Most investors that are gaining exposure to public markets, they are significantly overweight a small number of companies. Whereas in the private markets, you have a much broader array of both asset classes and in particular sectors of the market that you can capture returns.
Well, let's take one theme, which is what I'm asking about, say AI and the big push to develop energy and everything around it. Can I just get exposure to that in public markets right now when several massive companies, pick out some utility firms doing the same things? What is so special about what you're doing?
Look, what we are finding is more and more companies are choosing to stay private for longer or forever. And so the challenge is you might want to gain exposure to a part of the market that otherwise there aren't public companies available to invest in.
Why is that happening?
Look, there are many reasons why. I think first is many CEOs and company management teams, they recognize the challenge about being public. There is a lot of pressure on quarterly earnings. There is a lot of pressure on the immediate. When we work with companies and when we purchase companies, our focus is trying to find good companies and help them be great and give them the opportunity to build out a robust multi-year strategic plan that where they're not encumbered by the idea of having to worry about quarterly earnings every single day.
How hard is that when the technology is changing so quickly and multiples can change so quickly in terms of what the competitive landscape is and what the profit opportunity looks like?
Sure. Look, at the end of the day, what we're focused on is using a value creation toolkit to help good companies become great. And so our view is we worry less about the volatility of multiples, we worry less about the day-to-day, and our focus is on whether it's helping a company expand internationally, whether it's helping a company go into a new market. Our focus is trying to help these companies essentially take their business models and expand and grow.
Private credit has kind of eaten private equity's lunch over the past couple of years. A lot of people have gravitated toward the idea of getting your money back and then some. Do you think the pendulum is starting to shift back to the equity side of things?
Look, when we work with lots of different clients, and what I would say is all of them are continuing to allocate across the private market spectrum. We certainly have seen in the last couple of years increasing demand for private credit. This is a part of the market that, again, historically, many investors haven't had access to. What I would say is this: we see our clients allocate to the private markets on a strategic basis. So that incorporates private credit, infrastructure, and private equity. And so, we see value across each of these markets.
Can I ask you why you don't think this has happened? Just to go back to the start of the conversation, opening this up to 401ks. What stopped it from happening up until this point?
Look, I can't speak to the regulatory changes in market environment, but what I can say is private markets offers investors three really unique opportunities. Number one, to enhance returns. The second, to diversify risk. And the third, ultimately, to get exposure to parts of the market that clients otherwise wouldn't get exposure to. If you think about it, today, the correlations between stocks and public stocks and public bonds has increased. And so today, there's a real need for investors to find diversifying assets, and the private markets are a place to go.
Eric, appreciate your time. It's good to see you.
Thank you so much.
This is going to be an ongoing conversation for sure. Eric Mogelof there of KKR.
Yeah, you asked the question, and I think it's a really important one about what's been the obstacle. And there have been speculation about potential mismatches in duration, about liquidity. The issue is that you've seen ETFs and other instruments manage to slowly eat away at that. You also have this feeling that companies don't want to be regulated to the extent that maybe you have to be listed on the S&P 500. So they're staying private, and that sort of opened up this whole ecosystem. And I think that that's what you're seeing really come to the fore with this recent legislation.
Mark Rowan's talked about this issue so many times. Why do you need the daily liquidity if it's for an investment that ultimately you're not going to withdraw for, say, 40, 50 years. It's about retirement. You've got an ultra-long time horizon.
Yeah, and how many times have you seen companies being forced to make decisions that aren't in their long-term interests simply because they have to meet that quarterly earnings or the investor preference of the moment? And I think that that's one thing that people keep speaking to as well.
Futures this morning, just about positive by 0.2%. This from Peter Cheer. Can we just skip to next week? What's wrong with this week? It's nice and quiet.
Peter, hey, good morning, Peter. I think you're listening to us this morning.
There we go, Pete. Nice note this morning. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Apple will debut its first foldable iPhone next year, entering a product category dominated by its rival Samsung. But Apple is aiming to address some long-standing issues with foldable gadgets, like making the inner display crease less visible and improving the hinge mechanism. The phone is expected to cost at least $2,000. Meanwhile, President Trump is threatening to block the Washington Commanders' bid to build a new stadium in D.C. The president says he won't make a deal unless the team changes its name back to the Redskins, a term considered offensive to Native Americans. But Trump claims there's a big clamoring from them to restore the old name. And Scottie Scheffler put on a dominating performance to win the Open Championship, finishing 4 shots ahead of fellow American Harris English at Royal Portrush in Northern Ireland. This is Scheffler's second major tournament win this year and means he is now a U.S. Open title away from completing the coveted Grand Slam, and he remains so humble. That's your Bloomberg brief, John.
Yahira, thank you. Not even 30. Amazing. Absolutely dominant. Dominant's the word. Just absolutely dominant. Clinical.
Yeah, well, clinical is the right word for it. And as we heard from Yahira, very humble. You want a little bit more bravado, don't you? I think that you do. I think you wish you came out there and said, watch me crush this, instead of, every day at a time.
I think personalities like Bryson DeChambeau are great for the game.
Yeah.
Put it that way. Okay. This is an individual that I don't think wants to transcend the sport, wants to turn up on the weekend, dominate, then go back to his family. Nothing wrong with that.
Yeah.
It's not what you saw from Tiger Woods in the early 2000s, late 90s.
Want some flash,
just
some scandal.
Yes, some flash.
No drama.
Don't ever need the scandal, but
it's the Trump world.
Some personality. I don't want to be too brutal about this.
But I
He's a fantastic golfer.
No, you need to cast it a little differently.
Exactly.
Okay.
Up next, a make or break moment for earnings.
I think technology companies driven by artificial intelligence is going to be where you get your earnings growth this quarter. And that's what's going to make or break this earnings cycle.
Up next on the program, we'll catch up with Frank Lee of HSBC. This just in moments ago from the Treasury Secretary Scott Bessent speaking to the media this morning. The latest in his words to the press: we're more concerned with high quality deals than getting the deals done by August 1st. We're not going to rush for the sake of deals. That deadline, self-imposed, just a few weeks away. Equity futures on the S&P 500 shaping up as follows. We're positive 0.2% on the S&P, up likewise on the Nasdaq, up even more on the Russell. The small caps up by 0.7%. And the surveillance this morning, a make or break moment for earnings.
The leader of earnings historically in the U.S. is technology companies. So that's what we need to count on for this cycle. I think technology companies driven by artificial intelligence is going to be where you get your earnings growth this quarter. And that's what's going to make or break this earnings cycle. Markets are trading at a premium, and they need to be able to deliver these earnings driven by technology companies to support the premium valuations of the market.
So here's the latest this morning. Investors looking for spending on AI as Mag 7 earnings begin this week. Frank Lee joins us now, who covers chips for HSBC. Frank, good morning. It's good to see you.
Great. Good to have you here.
Got to talk about the news of the week so far. The news of the last week for the chip sector, just dialing up and dialing down restrictions on what they can and can't sell into China. How difficult is it to cover the names you cover when the policy changes from month to month?
Yeah, I think it's clearly a challenge is that, it's much more unpredictable. I think the focus, though, is the long-term narrative is unchanged. The spending, I think at the beginning of the year, there was a more of a concerning narrative whether the spending on AI, especially from hyperscalers, will start to slow going into next year, and monetization is still an issue. But as we come into the middle of the year, it seems pretty clear that the spending will continue. The hyperscalers continue to give the right messaging, and we don't see any slowdown. And also, we're seeing more of a focus on enterprise and sovereign AI, which we didn't really quite see so much at the beginning of the year.
Do you have a sense of why the administration made this U-turn on the H20 chips?
I think, it's something that, I think China is something that the market of AI is going to be significant there. And whether the U.S., I think they come to the conclusion that they're going to have to continue to be part of the story. They can't completely, avoid it. And I think, if you look at what NVIDIA was doing, they're already planning to focus on another potential chip that was going into China, an RTX chip. So I think now they're just being, reactive to it.
Does China have anything comparable to either of those?
I think it's going to be quite some time, but I think we are seeing that China has come up with a lot of very unique, different language models. And I think there's this view that, it's better to be part of the system. And if we can somewhat control it within our parameters, and I think that's something that perhaps the administration is more open to now than they were before.
Do you think the semiconductor companies are overly complacent to some of the threats of retaliation coming from Europe, in particular, this idea that there could be the anti-coercion initiative that they could put into effect? Do you think that actually will come into the fore when it comes to market activity?
I think that there's going to be a lot of discussions, but ultimately I think everybody wants access to these chips. And right now there's only a few number of companies in the world that can develop it. And I think that ultimately people will look for ways to compromise and open it up. So I don't think there will be as much rhetoric. I think the rhetoric will continue, but I don't think it will be as much of a significant impact.
What are you looking to learn in this earnings season as we hear from some of the majors?
I think basically the reassurance that the spending will continue, and that we're still in the early stages of this AI boom, and I think that basically will get reaffirmed through these earnings season as we progress.
Why do we have to wait so long for NVIDIA earnings? Frank, can you help us answer that question?
It's based on, I think, their calendar year, but I think even before that, we're going to get indications from all the other companies and the hyperscalers that this investment cycle will continue.
Right now, he can do whatever he wants. He seems to have a line into the White House that no one else has. It used to be Tim Cook, now it's Jensen Huang. What's changed in 8 years?
I think it's the importance of where they stand right now, right? I mean, they are at the center of AI and the chips, and right now there isn't any real competition to them. So in a way, it's almost a monopolistic nature. I mean, we are seeing some companies like Broadcom and AMD coming back, but still, he is still a leader of the entire AI.
He seems to be able to convince the administration, though, of his arguments, particularly with selling into China. And I think we saw that in the last week or so.
Absolutely. You had an export demand on the H20s in April. Then there was another meeting between Jensen Huang and the president. And a week later, he's off in Beijing announcing on his blog that the H20s are coming back. But this is someone, though, who's spent a tremendous amount of capital with this White House as well. Remember, he was at every leg of the Middle East tour. Tim Cook was not.
Can you think of a CEO or a company right now that has more power than NVIDIA and that man?
I think, he has been very good at communicating with the importance of AI, right? And I think this is something that he continues to pound on, whenever he has an opportunity. And I think part of it is that, when he talks to all the leaders, political leaders, I think they understand that more after speaking to him.
Frank Lee of HSBC. Frank, appreciate it. Thank you, sir. As Lisa has said repeatedly, got to wait another 10 years for earnings from NVIDIA, August 27th.
Well, he does it on his own schedule. He holds the keys to American exceptionalism, so he can do whatever he wants.
Apparently he does, and he will. Coming up on the programme, Eric Freedman of US Bank Asset Management, Aneesha Sherman of Bernstein, Claudia Sahm of New Century Advisors, and Chris Harvey, the biggest bull on Wall Street, joined us about an hour from now. From New York, the third hour of Bloomberg Surveillance. Up next.
The only thing that's certain is uncertainty.
This whole rally has been fought. I don't think anybody's going to exit the markets on concerns that is a certainty.
We're in the middle of a bull market. I think it has been around for quite a while, but it has legs to continue.
It's almost like chaos and uncertainty is just a given, and it's not holding people back, and the cyclical story can continue to remain.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Looking for record highs about 90 minutes away from the opening bell on the S&P 500 this morning. Futures are largely positive, likewise on the Nasdaq and on the Russell as well. For the week ahead, one thing sticks out. This week, it's the blackout period for the Federal Reserve. They go quiet, apart from one man. They go quiet until the meeting next week, next Wednesday. That one man is Chairman Powell. He speaks this week. In fact, he speaks tomorrow on the regulatory capital framework. So forget all of that. What we're interested in is if he pushes back in any way, shape or form against some of the headlines we've seen over the past week.
Does he come out and say, look, I am Fed chair. No one has the ability to fire me, including President Trump. The allegations around the renovations will be dealt with by this appeals board. But currently, I am planning to serve out my term. Ultimately, whatever he says regarding this issue is going to be noteworthy, even though it is out of the blackout period.
It is the story down in Washington, D.C., in the nation's capital, that just won't die.
It won't die. And you have the Treasury Secretary who likely will also be at that conference tomorrow. So it'll be interesting potentially if these two individuals see each other. Remember what Scott Bessent told us. He thinks that if the Fed chair were to stay on, Jay Powell, and serve out his governor term till 2028, that would be confusing for the markets and create a shadow Fed chair situation. Basically, what you have right now is they want some clarity, I think, on whether or not he is going to step aside or remain at the Fed.
I agree with Bramo. I don't think it's controversial to say it might be the story that won't die, but it's the story that everybody's just about sick of right now on Wall Street.
Yeah, I'm just thinking about that conference. And is it like the Jets and the Sharks, where like the Bessent crew and the Powell crew kind of walk by? Do they still have lunch every week? It's sort of
every other week.
Every other week. I mean, it sort of creates this interesting dynamic between the two of them when they're kind of pitted against each other. With Scott Bessent talking about the active search for his replacement.
Next week's going to be an interesting dynamic. They sit around that table at the Federal Reserve. Most people expect them to keep rates unchanged. Perhaps they will, but there could be some votes in there, some dissent, including from Governor Waller, who caught up with us just last Friday.
So how do they do it and keep the economic high ground? And this was something that Bob Michael really alluded to. How do they cut rates or indicate that they want to cut rates while showing that there is enough justification that makes it not just an audition to be the next Fed chair? And I think that is one concern. Does any Fed chair who takes the position next come with a lot of hair? I'm not talking about a nice head of hair. I'm talking about this idea that they're going to be motivated to be more dovish, and that is how they got into the seat.
Governor Waller had a nice head of hair, didn't he?
He does. He's got lovely hair.
Fantastic.
All
right. Futures positive by 0.2%. What are you laughing at? Okay. Coming up this hour, Eric Freedman of US Bank Asset Management with stocks climbing, Aneesha Sherman of Bernstein as consumer sentiment hits a 5-month high, and Chris Harvey of Wells Fargo with the most bullish S&P 500 target on the street. We begin this hour with stocks rising ahead of big tech earnings out this week. Eric Freedman of US Bank Asset Management writing the following: markets are front-running positive outcomes with earnings, tariff outcomes and capital expenditures. We still see some upside ahead of us. Eric joins us now for more. Eric, welcome to the programme, sir. Since we last spoke, we started to get some earnings. And since we last spoke, we got those earnings, and this market didn't do much in response. What do you make of the underwhelming response to some pretty decent earnings on Wall Street and beyond?
Yeah, to your point, Jonathan, it has been underwhelming. I think if you look at the thought process for investors like us, we're still waiting to see what the employment market will look like. And number two, what happens with CapEx. Those for us are the two big variables that we think need to happen to kind of push the markets higher from here. We have a target for this year at 63.25. That assumes, a little below consensus on earnings for this year, a little below next year as well. We start turning the page on 2026 in about 5 or 6 weeks. That's the way we kind of think through this earnings cycle. So in general, I think the thought process is simply this. This economy is supposed to slow down this quarter. We think it actually won't be as sharp a slowdown as consensus thinks. But we also think the bounce in Q4 and Q1 of next year will be positive. That being said, what we need to have is a bit more clarity on capital expenditures. That for us is the ultimate stir in the drink at the moment.
Eric, it's one of my favorite questions. Can you price the recovery to the slowdown we haven't had yet? Can you?
Yeah, I think it is something where the slowdown, Jonathan, is really in the eyes of what happens with consumers as opposed to businesses. Businesses are still in a really, really good spot in terms of flush balance sheets. Cash flows are generally very strong. But what we are seeing is still a hyper promotional environment to get consumers off the couch and actually out spending money. If you look at the elasticity of demand right now, not to go into microeconomics, but there's a lot of consumers who are looking for deals. That's not new. It just continues. And so the slowdown, what we think will happen if either companies become less promotional, in other words, they actually decide to pass through more of their tariff costs, if you will, or if businesses just stop hiring. And so those would be the two things that thwart our glass half full perspective. But in general, we think the slowdown has certainly been falsely predicted for some time.
Eric, your view on markets is sort of pro-risk, but sort of also a little wary of the valuations and wanting to sort of adjust things in real time to try to capture that valuation mismatch at any given time. How would you describe this investing environment, this sort of very nuanced, kind of grinding higher, sort of vaguely positive, but also wary moment that's very different from some of the either all the way up or all the way down that we've seen over the past few years?
Yeah, at least I think you nailed it. I mean, it is a very nuanced environment. And so the way that we're approaching this as investors is that, look, we're paid to beat benchmarks. And so the way we think we're going to do that is by out yielding them. And that's true across both our equity portfolios, but also what we're doing within fixed income. So in this environment, we had the opportunity, like every investor, to flinch during the post tariff announcements, post the very back and forth episode with tariff negotiations. We didn't, but we really sold into strength. And so now the question for us is, at more of a neutral equity posturing, what do we do? We think that we want to own more carry in terms of fixed income. We also want to try to out yield an equity portfolio. So again, favoring financials. Certainly still being involved with big tech, but also owning things like midstream energy that spit off some reasonable cash flow for investors. So to your point about nuance, Lisa, this is not necessarily an all clear environment where there's a great directional bias from consumers, especially those in the lower and middle income levels. Those for us will be the swing factors to propel us higher if, in fact, that glass half full perspective does come to fruition.
The one directional trade of 2025 has been the dollar, and it has been a one-way move downward or weaker versus all other major developed market currencies. I wonder how essential that bet is to the ongoing returns of equities in the way that we've seen over the past couple of months.
Lisa, at the risk of pandering, I'm a huge fan of your Twitter feed. And I think if you look at what some of the great things you put out is, this notion of correlation versus causation. The equity market move, the crypto move, the real asset move has at least been correlated with a lower dollar. And the fact that you still have the dollar consolidating, even after the Japanese election results yesterday or ongoing back and forth trade negotiations with Europe, that suggests to us that if the dollar cannot pick its head above its, let's call it mid-June levels, that's a level that we have not been able to surpass in about 4 or 5 weeks, of course. That for us suggests that at least in the moments, the dollar is still going to be a tailwind, a lower dollar, a tailwind for more of the pro-risk assets as markets determine just how strong this bounce, if there is a bounce, will actually endure. So for us, we're paying very close attention to, can the DXY pick itself above the 200-day moving average? If it does that, along with a slowing labor market, that may actually cause us to be a bit more cautious. But for now, we think that the bias towards a lower dollar is likely intact.
And you like your international exposure when it comes to Europe and Japan. How are you thinking about potentially, though, Europe and Japan having higher tariff rates than when the president came out and rolled back the April 2nd Liberation Day? Because right now, it looks like, at least for EU, it's going to be higher than 10%. And Japan, they are still trying to get that 25% on autos down. And right now, the U.S. isn't buying it.
Yeah, Annmarie, it's a great point. I mean, the fundamental picture, if you look at the average company in Europe, for example, look, we're seeing an improvement in labor laws. We're seeing a little more mobility of labor. That's a good thing. But to your point, there's only so much that a company can traverse if tariff costs go up above their ability to actually either endure them or pass them through to customers. So these next couple of weeks, we think that August 1st deadline, we'll see if it actually holds. But, the fact, if you look at some of the negotiations, again, you've done a nice job of reporting on this, we're really into the microeconomics of European-U.S. trade right now. That, for us, is a bit of a concern just in terms of the, again, at some point, perhaps there's just a throw the hands up in the air and say, we're done with this micro look. We're just going to increase the effective tariff rate above some really high hurdle. That for us would be a negative. So we think that for now, the fact there is still more back and forth on micro is a good thing. The average company fundamentals we think are actually solid. But that being said, a higher effective tariff, something, 15, 20% on a gross basis across the board, that for us would be more concerning about our pro-international positioning right now.
Eric, stop being so nice. I've tried. It doesn't work.
What do you mean it doesn't work?
I do it every morning. It doesn't work.
What, you feel like you're abused
Bully me every
morning?
commercial break.
Oh, yeah.
Eric, thank you, sir.
So we all
Eric Freedman of
so
US
mean.
Bank Asset Management with the latest. I want to share this with you, OK? Got some time.
Please.
This came from Michael Arue out on X. Here's the full quote. I'm not actually sure where the full quote is from, but here it is. People in the EU are super wise. You have a meal with some sort of French person who works in Brussels. It's very impressive. They're cultured. They have wonderful taste. They understand all these different countries. They know something about Chinese porcelain. And if you lived in a world ruled by them, the growth rate would be negative 1%.
That's amazing. Well, it's kind of been what's happened recently is that, the whole idea, right? The U.S. innovates. The China replicates, and the European Union regulates, and that's what we've heard. Thank you for catching my lack of mental capacity this morning. But there has been a push, though, in the EU to actually cause bank mergers and actually allows for more of this. But you're right.
Change the culture.
The Draghi report. How do you do that, though?
It's going to take a long time.
And what's wrong with knowing about Chinese porcelain?
Absolutely nothing, clearly, as evidenced by that quote.
Yes,
right, people are impressed by that.
Correct. But how do you translate that into...
You need to get beyond that and actually do things that generate growth. Right? OK, anyway, thought I'd share that with you this morning. Equity futures on the S&P up by 0.2%. Quiet, as you might have noticed. Let's get you an update on news worldwide with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. President Trump and Xi Jinping are reportedly expected to meet at or before the APEC summit in October. The South China Morning Post cites sources saying Trump could make a stop in China on his way to the summit in South Korea, or they could meet on the sidelines. Sources telling us here at Bloomberg that Trump has been dialing down his aggressive tone with China in hopes of securing a meeting and a trade deal. Meanwhile, EU officials will meet in the coming days to discuss how to respond to a possible no-deal trade scenario with President Trump. The move comes as the U.S. is set to be seeking tariffs on EU goods higher than 10% with limited exceptions. Like others, the EU faces an August 1st deadline to strike a deal or see higher tariffs. And Blackstone is out. It has pulled out of a bid for a stake in TikTok's U.S. operations. Sources telling us here at Bloomberg the firm has offered its potential share to other investors in a consortium that includes Oracle, Andreessen Horowitz, and General Atlantic. TikTok is facing a September deadline to find an American owner or be banned in the U.S. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes. Up next, the Morning Calls Plus. Aneesha Sherman of Bernstein as consumer sentiment hits a 5-month high. Live from New York, this is Bloomberg.
At a certain point, you realize investors are thinking a little bit differently than you are, and you adjust and move on. And that's what we did with our target raise last week. People felt like they paid the price for whatever economic wobbles we were going to have, whatever inflation, kind of challenges we were going to have back in April, and it was time to move on to 2026. As you start hearing it from more and more people, of different backgrounds, you realize you've got to bake that into your thinking. And so that's essentially what we did.
Tons of respect for Lori Calvasina of RBC. Joined us on the programme a little bit earlier. All of a sudden, this market has shifted its emphasis and focus beyond these deadlines around trade, what could happen, what might not happen with the Federal Reserve. It's focused on earnings in 26 and beyond.
If you can't measure it, why even think about it? If we're going to play headline roulette every single day and get whipside and be wrong, why not just ignore it all and move on to what you do know, which is the earnings and some of the investment that we keep seeing?
Lori raised her price target. We'll speak to a man who hasn't moved his price target at all. Oh, yeah. Chris Harvey of Wells Fargo later on the show. The most bullish on the street, north of 7K.
And he's been right. I mean, this is the amazing thing. The question is, are we getting to pretty lofty levels where we have to see some of the earnings come through, and we are embarking on a pretty massive earnings season where maybe we get a little bit more color other than just headline roulette?
So far, so good. On the earnings front, equity futures this morning positive by 0.2% on the S&P, up by 0.2 also on the Nasdaq. That's the price action. Let's get you some morning calls. First up, Benchmark initiating coverage of GM with a buy rating, saying its core business remains resilient despite tariff uncertainty. That stock is up by 0.4%. Your second call from Morgan Stanley raising its recommendation on Pinterest to overweight, citing improving macroeconomic trends. And finally, Barclays downgrading target to underweight, citing weak trends among the company's most frequent shoppers. That stock is down by about 1.6%. Let's stick with the retail and the US consumer. Consumer sentiment hitting a 5-month high as the outlook for the economy and inflation continues to improve. Joining us around the table, Bloomberg's Emily Cohn. Emily, good morning.
Good morning.
Things have started to turn around for consumer sentiment and the outlook for inflation as well. We saw that in the data on Friday. What's driving that?
So I think this is a little bit of a consumers are not going to hold out spending forever type thing. So consumer sentiment peaked, was its worst after Trump made his worst tariff threats. Now what we're seeing is a lot of those threats that he made early on haven't come to fruition yet. We're not seeing tariffs raise prices as much as we worried that they might. Some of the more tariff-sensitive categories, prices are up, toys, furniture. But for the most part, consumers aren't going to hold back spending forever. They're feeling a little bit more comfortable. They're spending again. I think the key here is we still haven't seen the worst that might come. And consumers, we just don't know, it might get worse.
This is what we're trying to figure out as well. Yeah. Just how much of these companies have been working through pre-tariff inventory, how much of this is about corporate resilience, or whether it's just the result of extensions and exemptions, and we haven't really seen the tariff hit just yet.
And depending on how you believe this to be shaking out, you'll get a sense of whether you see it to be inflationary. I think the thing that you pointed out there, though, is really key, which is the idea of contracts in place that set certain shipping rates. So you haven't seen those trickle into the actual pricing for companies in a large scale. All of these things offsetting just marginally in each particular corporate story.
Is this a risk for Q3, Q4? How are you thinking about the balance of risk for the remainder of the year?
I think you're 100% right. I think a lot of these companies bought a lot of their inventory months ahead. So a lot of the inventory that we're selling right now, maybe they had before the tariffs were in place. I think what we're going to watch is back to school shopping, holiday sales. Those are the types of inventory that these companies have to get a hold of or had to have gotten a hold of April, May, June, when the tariff threats were at their height. And we'll have to see if they begin to start passing those prices along to consumers more than they have to date.
Emily Cohn, it's good to see you.
Thank you so much.
Thanks for dropping by. Appreciate it. Let's extend the conversation with Aneesha Sherman of Bernstein writing the following. Secondary demand impacts continue to be a risk as price increases roll out, particularly for lower income exposed companies. Aneesha joins us now for more. Aneesha, welcome to the program. A lot of companies in your coverage. Talk to us about the companies right now that seem to be in a tough spot.
Yeah, so we have had these August tariff announcements come out. They are better than feared. So we've seen some of the stocks rally, but they are worse than the pause rates that we're at currently. And so we should see tariff impacts worsen across the back half. Now, the challenge is the timing. So we're about to enter the Q2 earnings cycle. These August tariffs don't impact Q2, both on the supply side, because that August shipment inventory is Q3 inventory, and also on the demand side, as your previous guest just said, the price increases that started to roll out in June and are ramping in July and will continue to ramp in August are not going to materially impact Q2 earnings. So it's really the back half earnings that are at risk from a worsening tariff environment compared to the pause rates. And we'll see, because some of these unmitigated impacts are kind of 100 to 250 basis points of gross margin headwind on most of my coverage, but that's the unmitigated impact. And these companies have now had months and months to work on mitigation efforts. So the net impacts of those could be smaller. So, the net message is it will be worse, but it could be just slightly worse. It might not be a doomsday scenario. And we'll have to see what the Q3 guidance looks like, and that's going to be the main data point I'm looking for in the earnings cycle.
What have we learned so far? And I realize it's very early in the earnings cycle, but we've heard from the likes of Delta. We heard from Domino's doing great with their stuffed crust pizza this morning. I'm just wondering, what have we learned about consumer tolerance for higher prices, consumer willingness to keep spending, and their ability to do so?
Yeah, it's interesting because we've seen this consumer sentiment data get worse and worse, right, up until this month. But we haven't really seen an impact on spending. And really what's going on is it's an anticipatory sentiment decline where our consumers are reading the news and the headlines in the media. They're worried about tariffs hitting the price points, but we haven't seen that happen yet. And so we're seeing a deterioration in sentiment. And even now, July has gotten a bit better, but it's still far worse than it was at the start of the year. But we haven't seen that translate into a spending pullback yet, particularly for higher income consumers who tend to be lower beta anyway, and they are less impacted by a change in price points. I think that where we might see the other shoe drop is depending on the magnitude of the price increases, we could then see a pullback in actual spending. So that has not happened yet. And I don't think it happens in Q2 either, because like I said, those price increases have barely started towards the end of Q2. So late June and July is when those price increases are going to start to ramp. So we could see it in Q2 exit rates for some of the retailers that end their quarter at the end of July. But really where we're going to see it is in early Q3. So the commentary around quarter to date, Q3 trading, Q3 guidance, and data points around most recent consumer trends, that's where we're going to start to see the demand impacts we haven't seen yet.
Governor Waller was on Friday, and he was talking about the impact of tariffs. And he said it's a third across the board. Suppliers hit a third, firms hit a third, and the consumer absorbs a third. Is that how you view how it's distributed across the supply chain?
Not yet. So far, what we've seen is suppliers have borne the brunt of it. And we've talked to many suppliers that sell to some of the big general retailers here in the U.S., and they've said those retailers have just pushed back on suppliers and said, you guys need to bear the brunt of this. And remember, the retailers are in a much better bargaining position here. They have diversified supply chains across multiple markets, across thousands of suppliers, so they can't afford to do that. As those tariff rates now increase, so comparing the August 1st rates versus the pause rates, that next leg up is going to be borne by retailers and consumers. So far, it's been disproportionately pushed to suppliers as companies have tried to do cost side mitigation and not pricing side mitigation. That balance is going to shift. So I don't know if it will be fully a third absorbed by retailers. I think the retailers are going to try to pass them up and down the supply chain and onto consumers. But I do think that rough proportionate split is right. So far, it's been very supplier absorbed. That's going to shift.
Aneesha, always a clinic with you. Appreciate your time this morning. Thank you. Aneesha Sherman there of Bernstein, reflecting what many expect later this summer, which is prices firming up. Got a hint of it in CPI just last week. A lot of people think it will continue. The debate is whether it continues to beyond that, whether it just fades beyond that. And I'm pleased you brought up Governor Waller because he makes two assumptions. One, a large share of tariff increases won't be passed through to the consumer. But two, increases would fade over the next year or so. And that's the ultimate call for the Federal Reserve. Do you look through it and carry on your business?
And a lot of it hinges on wage growth, and that's what we heard Bob Michael talk about. And if you don't see that labor market pressure and the tightness in the labor market that leads to that kind of wage growth, you aren't going to see consumers really doubling down and accepting those higher prices. I just look at Domino's, and pizzas are, $10. So if you buy more of them, what's the only thing that could make a perfect pizza even more perfect?
There's better pizza in New York. I'm going to take you to Arthur Avenue, but the Michigan survey on Friday, I know Governor Waller just calls it that thing, that Michigan thing, but actually the sentiment was up even on that thing. And he makes this case that you can just look through this tariff impacts. Even if it hits a consumer, it's just going to be a third.
Is that your favorite pizza, Arthur Avenue?
Well, it's the best Italian food in New York.
Okay.
It's good, but, across stuffed full of
just
cheesy goodness.
All right.
No, it's good.
Me. All
That's
right.
it? It is. It's great. It's excellent.
Quite basic.
Amazing.
Ruby Rosa, Mulberry Street.
Ooh.
Yeah.
They have gluten-free pizza.
Yeah,
it's fantastic
so it
pizza.
Is good.
Okay, good to know. 60 minutes away from the opening bell. Equity futures doing okay, positive by 0.2%. Let's get you some morning movers this morning. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Some more earnings this morning. Cleveland-Cliffs, that is the steel maker. Shares are higher in the pre-market, reported a loss of 50 cents per share. That is better than what's expected, but maybe it's the look forward. The CEO talking about how tariffs on the steel industry are going to be helping them and other domestic manufacturers. So they're really seeing that start to play out now. So again, those shares up 6.33%. We also heard from Verizon in the past hour. Those shares up 4%. An upgrade for their full year outlook, also for free cash flow, beating because they say of tax reforms, strong businesses, and they also were able to raise prices when it comes to their wireless business. Finally, rounding things out with Tesla, just pointing out that it is gaining ahead of its earnings report on Wednesday, 1.6%. Possibly helping things out this morning, too. Elon Musk was out on X yesterday saying that he's back to 7 days a week in the office and sleeping in the office when his little kids aren't around. So it's perhaps that recommitment to his companies and away from politics that investors like, John.
The work ethic of that man. Unbelievable. Tesla positive by 1.6%. Danny, thank you. Let's turn to the week ahead. Busy week of earnings. That kicks off on Wednesday with Alphabet and Tesla. Lots of economic data as well. Look out for another round of jobless claims on Thursday. And interestingly, we're going to get a speech from Fed Chair Jay Powell. We'll get that speech tomorrow. Bloomberg's Mike McKee joined us now for more. Michael, as you know, we're in the quiet period from the Fed. What can we expect from Chairman Powell?
Not a whole lot. This is a conference on banking regulation, the Basel III agreement and the SLR and things like that. This is not going to make any news. He's not going to be able to comment on anything to do with the economy or monetary policy. Vice Chair Mickey Bowman speaking at the same conference. As you mentioned, it is a kind of quiet week otherwise, and we hate to get people's hopes up. But the breaking news today is Jay Powell is, at the moment, still the Fed chair. And we haven't heard from Donald Trump about that in 24 hours. So we'll see how the rest of the week goes. As you mentioned, we do have those speeches tomorrow. We've got the leading indicators index, which we have all forgotten about because in 37 of the last 41 months, it has been negative. So it's been signaling recession for 37 months out of the last 41, and we haven't gotten it, so nobody really cares that much about that. But that used to be a big number. Existing home sales and new home sales also on the calendar this week, along with, as you mentioned, the jobless claims numbers. And we get S&P PMIs on Thursday. We'll see what they tell us about next week's ISM number. The one thing that's interesting to watch here is even though the president may or may not have backed off of Jay Powell, the markets are still a little bit concerned. If you look at the 10-year note yield, it is above where it was before the president last suggested that he is going to fire Jay Powell. So there's still some concern in the bond market about that. Everybody will be keeping an eye on the president's social media feeds and our headlines to see if anything changes in that regard this week.
Mike McKee, next week. Let's talk about next week. You'll be in the room with Fed Chair Jay Powell next Wednesday. How much of that news conference is just going to be about that man's future?
I don't think a lot, and only because Powell has been very clear that he's not going to talk about it. He's going to probably just tell us he's not quitting, and if the president tries to do something, they'll sue. What will be interesting, though, is to see the breakdown of the vote and see if Chris Waller, a candidate for Fed chair, dissents, and if Mickey Bowman, who has also said July might be a good month to have a rate cut, also dissents and suggests some sort of rebellion against the Fed chair.
Michael McKee, thank you, sir. Looking forward to your coverage over the next week. Just a little tip for anyone going to that news conference with Chairman Powell. He likes the one-word answer. Have a spare question, OK?
Smart.
Just so you can come back at them again. Maybe have another one after that so you can come back again.
Yeah, or you could do open-ended questions. Are you concerned about Fed independence? Do you think that this is going... OK, all right, hold on a second. And then, do you think that right now that affects the way you communicate and the fact that the market is taking a very different communication? No? Right?
Nope.
I mean, but then you just sort of... I imagine people keep trying.
I'm totally with you. We explored this with Governor Waller last week, and I think it's a really important question. Whether we're seeing this pressure lead to a de-anchoring of inflation expectations because people do think central bank independence is being eroded. Now, we don't see any sign of that at the moment, at least not in a major way. But I wonder if that would contribute to how they do communicate in the coming months, whether it makes them ultimately just that little bit more hawkish.
Exactly, because otherwise you could ask, well, why not cut 25 basis points if you don't see this really affecting inflation expectations at this stage? You can ask all these questions and then say, okay, but what about the political potential ramifications and how much is that stymieing that decision?
Mike talked about a rebellion potentially from Governor Waller and Mickey Bowman. Is it a rebellion or what Governor Waller said around this table on Friday, which was you should have diversity of thought. This is a deliberative body. We don't need to all move in this think tank setting where we all move at the same pace and in the same direction. There should be debate. So if he comes out with a dissent, it's going to be a real debate. The question is, can he bring the rest of the board over with him?
A dissent is healthy. It's unhealthy if you think every single dissent is just driven by someone who's motivated to become the next Fed chair.
Well,
that's problematic.
That's exactly it. So there could be legitimate arguments economically, but do they get overshadowed by some of the political noise? And that's one of the ramifications of really having this ongoing
But
discussion.
also, Trump isn't calling him yet. He still has this veneer of being super independent in the sense that Trump has not reached out to him yet. He said that at his speech in New York, and he said that here on Friday.
Let's continue the conversation. Claudia Sahm of New Century Advisors joins us now for more. Claudia, welcome back to the show. It's good to see you, as always. I want to pick up on that speech from Governor Waller, what he said before our conversation with him. Looking across the soft and hard data, I get a picture of a labour market on the edge. Do you get a picture of a labour market on the edge?
That's not how I would characterize the labor market, but I think Governor Waller lays out a very reasonable argument for reading the data. Right, the labor market had some cracks, has some weaknesses to it. I mean, I think they were maybe more apparent last year, as the unemployment rate had been rising. But he paints a picture and he ties it to data. Again, I think it's really unfortunate that it becomes wrapped in this conversation of, is this a politicized view of his? I don't see it that way. But just to have that kind of injected in the conversation does tend to undermine what he's saying.
Claudia, do you think from your perspective and your years of experience studying the labor market and how that affects Fed policy, do you think that right now weakening in the labor market really is a greater concern than a prolonged, protracted inflationary push from the tariffs and from strength that we have seen ongoing in corporate America?
So I would agree that there are several threats on the growth side to policies that have been put in place. I mean, tariffs have an aspect of weakening growth through the higher prices. We've seen immigration policy. I mean, there's a whole set of reasons why you look out at this year, and we've seen growth slow this year, and that'll eventually show up in the labor market. So you definitely can see those risks. And if one, as Christopher Waller lays out, looks at the potential inflation risks and says, these are temporary, we can look through these, then I think you would be right back to where we were, in 2019, where the Federal Reserve faced with tariffs, they cut preemptively. It's just we're not in an environment where inflation is subdued. It's actually been above target for more than 4 years. There are real risks there. We still don't know what the tariff policy actually is. It could be going higher. It could not. So there's just a lot of uncertainty, I think, with the way that the kind of majority of the Fed is lining up their arguments makes a lot of sense. But there is a real perspective, and I would agree that the diversity of thought on the Fed and making those arguments carefully with data, that's a good thing. It is extremely unfortunate, the environment, by having the White House and the president very directly say what they want to see in terms of rates. It's kind of created this, it's made it really difficult for the Fed to have this kind of disciplined data conversation.
And it's even more difficult by the fact that the data is really confusing and it can paint a different story depending on how you read it. I mean, we keep kind of wondering what the labor market is showing us, whether it does show some sort of more dramatic weakening or whether the housing market is kind of ringing a 5-alarm fire alarm saying, hey, there clearly is a problem. I mean, at what point do you think that keeping rates at this level would really create a weakness that currently hasn't manifested itself in the economy?
We're likely pointed in that direction. I mean, the economy has proven quite resilient. I mean, this is not just talking about this year, but in recent years, the higher interest rates, and there are probably a lot of different reasons for that. But eventually, we do see in interest rate sensitive sectors like housing, we do see these rates weighing down. The reason that the federal funds rate is elevated is because it is trying to push down on inflation. Once the inflation issue is taken care of, well, then there's no reason to have the rates as high as they are, and you should see them coming down. And the Fed tells us that's the direction they're pointed in. They're just not ready to take that move. But there are costs there are costs in the economy to the Fed having interest rates as high as they are. And we will see those costs build as interest rates stay higher. So, but we're not looking at some dramatic falling off a cliff. We're looking at more of a slow grind, and it does impact certain parts of the economy, certain consumers, people trying to buy homes. Like that is where the effect is. But the goal is to get, inflation down. Unfortunately, we've gotten data that it's moving in the wrong direction. That may be temporary, but like there's a reason that rates are where they are. It's not. But there are costs.
Governor Waller, though, is looking at these cracks in the labor market. Even individuals like Mary Daly is talking about it's reasonable to expect 2 cuts this year. Claudia, when do you expect the Fed to first move?
So it will absolutely depend on the data as they go forward, but there is certainly a case. And I think, keep an eye on the inflation data that's not connected to tariffs. I mean, I think that's actually been part of the encouraging cases that we've seen some weakness in some discretionary spending areas, and housing has certainly shown some cooling off. So I think they're building, the data are building the case, as long as, the tariff risks don't really move much higher, things really go dramatically sideways. I think they're on track for September or October, as the data come in. And Governor Waller could absolutely be correct that we see some employment numbers that are not as positive as recent ones, and that could move them much more quickly to the cut. But I think the data thus far have supported their let's wait and see. And I think that's where they're going to come down as a group next week. But of course, you can look at the data differently, and they are pointed in the direction of cuts. I mean, some aren't even looking for them this year, but I mean, that's, they have a lot of coherence in what they're thinking. It's just timing is hard. It's just really hard to figure out because timing is hard in the economy.
Claudia, I appreciate your time. As always, Claudia Sahm there of New Century Advisors. Just to echo everything Claudia said, particularly at the end there, the bias is still to reduce interest rates at the Federal Reserve. That is still the direction of travel.
And that would have been even without the pressure from the White House. And I think that's really the important point here. How do you message it now? And how much does it get complicated by the political overlay that currently exists?
I agree with her also that it's super unfortunate that this is where we are. The credible arguments for lower interest rates are just being basically accused of ambitious goals to become the next Fed chair.
Yeah, especially because a lot of economists on Wall Street have been making the same arguments for quite a while. And that, I think, really goes to the heart of the legitimacy behind a lot of these arguments.
Let's see if we get some healthy dissent at next week's meeting. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahara. Hey, Yahara.
Hi, John. Microsoft server software was exploited by unidentified hackers. The U.S. Cybersecurity and Infrastructure Security Agency said they accessed file systems and internal configurations, while Microsoft said it released a new security patch to mitigate the attacks. The Washington Post is reporting U.S. federal and state agencies are among those affected. Meanwhile, a Delta Airlines jet was forced to abort landing to avoid a mid-air collision with a B-52 bomber. The incident happened last week in North Dakota near an Air Force base. Citing the pilot, ABC News reported the plane had to make an aggressive go-around maneuver as the other aircraft became visible. ABC News also says that afterward, the pilot apologized to passengers. And President Trump is threatening to block the Washington Commanders' bid to build a new stadium in D.C. The president says he won't make a deal unless the team changes its name back to the Redskins, a term considered offensive to Native Americans. But Trump claims there's a big clamoring from them to restore the old name. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next, we'll set you up for the day and a week ahead. Plus, we'll catch up with Chris Harvey of Wells Fargo with the most bullish S&P 500 target on the street. That conversation up next.
I don't see 10-year yields at 5%. I think they belong at 5%. And that's the great puzzle that they're not there. That's telling us that there's constant demand for government bonds. There's constant demand for the bond market out there. Every time I meet with investors, they're trying to figure out where to get into the bond market.
Bob Michele of JPMorgan Asset Management on the programme a little bit earlier this morning. In the market right now, equity futures positive, bonds are too, yields are lower. Futures are up by 0.2%, and your bond market looks like this: 2s, 10s and 30s. Your 30-year yield is south of 5%. We're down 6 on the session to 492. Your 10-year is 436. Bob Michele saying, I don't see the 10-year at 5%. He sees reasons that they belong there, but he doesn't see them getting there.
Which shows the incredible bid for bonds and how globally there's this incredible demand. I would argue that what we're seeing today is a bit of the Japan effect, how we're getting whipsawed by the fact that it's not as bad as it could have been with sort of fiscal irresponsibility, potentially maybe on the Japanese side. But, you know, he's making an argument for bonds. Let's see what happens if the Fed cuts by 50 basis points.
You think the Fed cuts 50 basis points?
No, I don't think so, but I'm saying that what happens...
Worth exploring that.
Like, just basically counterfactual on this Monday morning.
If they went 50 next week, for instance, what would happen to the long end?
It would probably... You'd see yields up, you'd see price down in a significant way, and it would raise questions about independence.
Which is what we saw at the back end
Correct.
of last year. Futures this morning then, just about positive by 0.2%. The bond market doing okay. Thank you, Japan. According to Lisa, Japan in the driver's seat in many ways over the past few weeks in fixed income worldwide. That's the price action. Your week ahead is shaping up as follows. Coming up a little bit later in the week, we'll hear from Fed Chair Jay Powell speaking at the FOMC's regulatory conference. On to Wednesday, results from Tesla and Alphabet. On Thursday, a rate decision from the ECB and earnings from Intel and American Airlines, plus another round of jobless claims. And then on Friday, going into the weekend, durable goods. Let's stay on the market. Stocks trading near all-time highs. Chris Harvey of Wells Fargo, the most bullish man on Wall Street. S&P 500 price target of 7,007, and he joins us now for more. Good morning, Chris.
Good morning.
You uncomfortable with that? I want to give you some credit before we start. Credit to you for not changing this call in the tariff storm of early April. So let's start there. Why did you stick with it?
So 9 months in the financial market, that's an eternity. The other thing, we had seen Trump 1.0. We know his style. It's to go out to the nth degree and then to come back in. Furthermore, the underlying fundamentals were still fine, and our EPS and our price target wasn't predicated on a strong economy. What we're seeing is the winners continue to win. The uber cap companies have the higher margins, are gaining more market share. There is a real secular trade in AI that will continue. I was here during the 90s. This is not a fair comparison. It is much stronger and the fundamentals are much better than today than they were back then.
7K is not tariff dependent. It is not August 1 dependent.
No. So people ask, well, what's the fear? The fear is, there's a couple fears. One is, do tariffs start to flare back up? And that's possible, right? We just can't predict that. The other fear, which is a much more real fear, is what's happening with the Fed. Do we worry about the Fed and confidence in the Fed? Because the back and forth between the Fed and the White House, that's not healthy, right? And that can cause problems in the bond market, and that can cause problems with confidence. But overall, we're starting to see M&A activity kick up. We think that M&A will continue to be very, very healthy up and down the capitalization. We do think the Fed's going to cut. Fundamentals are fine. The consumer's okay. And we're not seeing the kind of price increases that people are talking about. We're seeing people say surgical when they're talking about price increases and selectively.
So there's a lot to unpack there, and we'll get into the Fed independence in just a second, and what point yields have to rise to before that really triggers some sort of response in equity markets. What about valuations? The idea that you're talking about an 11% gain from where we are right now on the S&P 500 after already reaching record highs amid a wall of worry and, frankly, growth that is expected to slow.
Right. So we talk about this all the time because people say, oh, look at 20 years ago, look at 25 years ago. The S&P is not the same as it was 25 years ago. The constituent of the S&P 500 is much more growthy. It's much more techy. The multiples are much higher. The productivity is much better. The people running the companies are much more attuned, and the acumen is much higher. And so the valuation, yes, it's high, but it's justified in our minds. And again, we don't need to see a whole lot of multiple expansion to get to that level. We're not very far from that level at this point in time.
So valuation concerns don't really you don't spend a lot of time on those. I do want to go to the Fed independence side, though. There is a question of what point yields have to rise to before it triggers true concern in stock markets? Because we've asked that questions many times. People give us a level, and then we pass that level, and stock markets shrug it off and say, healthy, healthy, good.
Yeah, I really, it's hard for me to really answer that question. I think what's happening right now is you had Trump come out and say, I'm not going to fire Powell, right? And I think he needs to go out and say that, right? There's a lot of talk and rumors and situations in the marketplace. At the end of the day, we need the Fed. We need the Fed to be independent. We need the Fed to be apolitical, because it is a very important part of our marketplace. And as long as we can do that, that's great. I don't know if rates really have a play in this. I think it's just cooler heads need to prevail.
You read Trump correctly when it comes to tariffs. He put out a truth over the weekend about what Bessent potentially laid out to him when it comes to the market impact of firing Bessent. People don't explain to me, I explain to them, says the President of the United States. Did you take that as him basically acknowledging he understands the negative impacts that could have on financial markets?
I think his team understands. I think he understands. I think if you go back, and one of when we were on the show a while ago, we were talking about, will the feedback loop close, right? Will the administration see what's happening in the capital markets and react to that? And they did. So I do think they understand, but I also think that he feels like he's playing with a very strong hand, and to a certain degree he is. And one of the things we are beginning to worry about it is he's looking at tariffs as a revenue generator, right? We have what we have with the deficit, and saying, hey, this could be a good way to reduce the deficit. We haven't seen the real impact to the economy. What's the big deal?
In that same truth, he said if it weren't for him, the market wouldn't be at record highs right now. But if it weren't for him, would potentially already be at your 7007 mark.
Yeah, there's a lot of speculation on speculation there. I think we could have done this. Talk in my book, one of the things I said, and one of the things I believe is you could have put a 10% tariff on and then just walked away. Right? We talked about how there was a seller's tariff and how people, whether it's through Airbnb or Amazon, they understand it. You had Congress put that 10% tariff on, walk away, and we can do something more productive. But we chose this path, and it's okay. It's a little bit bumpy, but we're getting there.
Might get bumpier. Peter Schiff Academy. Without the markets pressuring the administration, why would they pull back going into next month?
Well, this to me is the key question. How much is this administration playing chicken on tariffs with the market? If the market's looking past something that hasn't happened yet, does that push them to potentially go even harder because they could extract more? They could offset the deficit concerns from the one big beautiful bill. And there we go.
And you see these countries lining up to really want to do deals and getting a little bit nervous when you have Howard Lutnick, the Commerce Secretary, coming on Sunday shows saying August 1st is a hard and stop deal. Also, he's already telling us what to expect next year. He said, of course, we're going to renegotiate USMCA so we could prepare for more headwinds in terms of Canada, Mexico, and the United States.
It's going to keep coming. It's going to keep coming. Chris, just to wrap it up, the US versus the rest of the world. What have you made of that debate over the year so far?
So we thought that was possible. We thought that was probable early in the year. It happened. Now we're just walking away. We just don't. We're done. We're good. You had that repricing. Now let's go back to fundamentals, and the fundamentals are telling you back to the U.S., back to growth.
Chris Harvey of Wells Fargo. Appreciate it, sir. Thanks for being here. It lasted how long? 5 months? 6 months?
Always a tourist in Europe. That seems to be what it is, whether it's markets or whether it's otherwise.
That's beautiful.
Thank you.
You should frame that. That's a fantastic quote.
Well, I mean, that's sort of how it feels to me. And people sort of get excited about the prospects of growth, and then they head over there and experience the regulation and some of the other hang-ups with certain labor market structures, and then they come back here. And that's been what it's been going on for a while.
Always a tourist in Europe. Bramo. July 21, 25. Coming up tomorrow, Man Miskin of Manulife, John Hancock, Russ Brownback of BlackRock, Dan Niles of Niles Investment Management, Andrew Hollenhorst of Citi. From all of us, thank you for choosing Bloomberg TV from New York City. This was Bloomberg Surveillance.